the four candidates that were out there, I would say that Walsh was probably the worst.
I expect him to be tested in the same way that markets tested every single central banker.
This is going to be a very interesting confirmation process.
I fully expect that Kevin Walsh will get through eventually.
What's going to be more important is how the economy evolves.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, meeting gravity. This year's big winners now threatening to undo this year's equity gains as the explosive rally in precious metals develops into a three-day rout. And AI's big funding needs are receiving a skeptical response. Jensen putting a question mark over OpenAI.
So this is the exact quote when he was speaking to reporters over in Taipei. It was never a commitment. He's talking about the $100 billion investment in OpenAI. They invited us to invest up to $100 billion. I also invite anyone to invest up to $100 billion in me. And of course we were very happy and honored that they invited us, but we will invest one step at a time. Why was he doing this? What was he signaling to markets, given the fact there are a lot of ways to phrase this? This seems like a full step back from this commitment.
Particularly after this followed a Wall Street Journal report going into the weekend that suggested he's indicated and criticized the lack of discipline in OpenAI's business approach. None of that looks good. Spare a thought for Oracle, who are also coming out with all of their funding needs for the year ahead and saying they need to raise as much as $50 billion this year. Not great timing for that headline from that company.
Yeah, $50 billion in debt and equity, and right now you're seeing the stock say, I don't think so. And right now there's a real question, is there overinvestment in the wrong assets? And the fact that NVIDIA suddenly is saying, hold on a second, we need to reassess, raises some questions about this trade, but also the messaging. Jensen Huang has to know what the market's reaction is going to be. So why would he phrase it this way? And by the way, I also would be grateful to invite anyone to invest this amount of money.
Well, he was forced to phrase it this way because the Wall Street Journal reporting over the weekend, basically Jensen Huang putting a lot of criticism on OpenAI, even though he'd come out and said he thinks it's a fabulous company, it needs to do well, and NVIDIA wants to invest in it. Over the weekend, the Wall Street Journal really digging into some of his private comments behind the scenes about the concern he has and what he calls the lack of discipline at OpenAI.
It's a tough start to the week for a lot of people in this market. Let's put it that way. The Kospi in South Korea down by 5%. Gold and silver getting absolutely hammered over the last few sessions. Gold off the lows, we're still down by 4%. Energy in the mix as well. We've all talked about that tight relationship between precious metals and equity risk. You're seeing that play out this morning.
Yeah, although the why is sort of a big question. How much is this technical and how much is this fundamental? There's a huge discussion around the short squeezes that have taken place and the fact that even if you see the biggest two-day sell-off in silver on record, you still are up for the year if you bought at the end of last year. So a real question here about whether this is just a pop off the top or whether this is something that has deeper significance.
We've got a lot to talk about this morning. Coming up this hour, we'll catch up with Lori Calvasino of RBC as this year's big winners unwind. We'll speak to the former senior U.S. intelligence official Norman Rule as U.S.-Iran tensions ease. And Andrew Sheets of Morgan Stanley as markets struggle to price a Kevin Walsh-led Federal Reserve. We begin this hour with stocks sliding on course for a fourth day of losses as precious metals plunge and the AI trade meets some resistance going into earnings this week from both Alphabet and Amazon. Joining us around the table is Lori Calvasino of RBC Capital Markets. Lori, good morning.
Good morning.
What would you tell clients who ask you, Lori, what is this morning?
So, look, I think there's a whole lot of stuff hitting the market all at once. And we said coming into this reporting season that it was a chance for investors to kind of push the macro aside and focus on the micro. The macro has been pretty pesky in terms of sticking around in unusual ways. And I would also argue that the micro has been a little bit underwhelming. If you look at the beat rates and just a very simple, kind of gauge on how reporting season is going, last week, it was about 77% of companies were beating consensus estimates. Now, that sounds good. This is for the S&P 500 until you go back and look at last quarter when it was like 83%. So, and we're seeing similar things on the rates of upward revisions, about 51.4% to the upside. Back in September, that was 65%. So, we've described this as slightly squishy, not a disaster, but not good.
Squishy is not a word I would use to describe what happened with Microsoft just last week. Luckily for them, Kevin Walsh happened to the Federal Reserve, and we barely discussed it on Friday. Is that a warning ahead of Alphabet, ahead of Amazon?
So, look, I think the other thing we have to contend with, if you go back to the second half of 2025, and it seems like ages ago now, it's been such a long start to the year, but we really noticed all the way back on Labor Day that we were seeing AI jitters coming back into the market. We've seen the PE multiple of the S&P 500, just a simple forward PE, hit a ceiling and be unable to penetrate trade it since really August. So we've been kind of seeing the multiple shift around. And I think especially on these top 10 market cap names, they're pretty much priced for perfection. The bar is high, and there's not a lot of room for error. I'm not an expert on any one of these individual stocks, but I can tell you that there was a healthy appetite, even before all of these macro issues sort of hit the market, of diversification. Do we need to diversify away from some of these big mega cap growth names? And that hasn't gone away.
Are some of these big mega caps passing the baton in terms of earnings growth to smaller companies? Or is the squishiness that you're talking about pervasive across different tenors of the equity market?
I feel like some of that is going on within technology, but I'll tell you as a generalist, when I look at sort of the broader S&P 500, I'm getting very frustrated in my reading. And so, I think it's pretty well known by those who follow our work that we spend a lot of time on my team reading through earnings call transcripts. Nobody wants to talk to us during earnings because they're all busy, doing the same thing. And the reality is that I get excited when I get to the tech companies. Like when we finally got a bunch of them last week, I felt like I had better things to read. And I do feel like, if you're going outside of tech and looking at the end users of AI, right, which is sort of going to be the next phase, they're using better examples and they're getting more granular and it's more interesting stuff to read. It's not just like, hey, we're adding to efficiency. Hey, we're adding to productivity. They're giving us some real examples. But I almost want to say, where's the beef? Where's the numbers? Where's the numerical impact to revenues? Where's the numerical impact to margins? Where's the numerical impact to earnings? We're just not getting it yet, and it's probably because it's not there to get. And I think that's the issue with kind of rotating within this AI trade. I can kind of see it happening within the tech space, but is it broadening out beyond that tech space where we're seeing really measurable impact? I don't think we're getting it yet.
So what would it take to get to another phase where suddenly you could see equity markets rise in tandem and the hope for AI to come back? Or do you see this as actually beginning the sort of step down in terms of valuations and enthusiasm?
So, I think that valuations can generally hold pretty steady, but I do think what it has encouraged me a little bit is that in the Q&A portion of earnings calls, we are starting to see analysts ask the question. And, that's where some of these better answers are coming out. And I forget which company it was, but there was one that actually said, we wish we had better specifics to give you. And I thought that was actually a very intellectually, kind of honest response. So I do think the analyst community is starting to push a little bit harder, but I don't think we're going to necessarily get it this reporting season.
When you look at the discussion when it comes to the earnings report, some of the commentary you talk about in your note is the consumer color.
Yeah.
What is these companies saying about the consumer right now and the health of the consumer?
So you kind of have to take it week by week. And if you go in the first 2 weeks, we mostly got sort of derivative looks at the consumer, meaning, big banks coming out and telling us, hey, all the stats look good. We're not seeing any red flags. That's been a very consistent message for several quarters now. And that does feel like it's holding up. I would say last week we finally started to get some specific consumer companies that really understand what's going on boots on the ground level. That messaging hasn't changed all that much, which you're still seeing, kind of the companies that are more on the experience side of things are saying things still look pretty good. That's been a key theme. We did see one consumer company, really, kind of talk about how they had seen weakness in big ticket items and those sorts of things. So I would say the narrative is still coming out, but it does seem to be pretty consistent with what we heard last reporting season, which is, yes, the aggregate spend is still healthy, but there are problems underneath the surface. Not in every company, not in every vertical. People like to go around and, talk about whatever fits their narrative. But if you look at it broadly, it is still pretty mixed. And there's still signs of consumer stress under the surface.
Overall, though, it does seem like, based off this reporting, the consumer is resilient. What else is standing out to you that basically is on concerns of the C-suites?
So I would say early on, the first 2 weeks, and I did feel like I heard less about this last week, but it just felt like the first 2 weeks geopolitics cast a pall over the entire kind of broader outlook discussion when companies are sort of talking about kind of vaguely, kind of what they're expecting in the year ahead. That did feel like it got a little bit better last week. I think that for all the financial companies, and they were still, a significant chunk last week, but sort of the interest rate credit card cap issue was coming up. We are seeing other policy discussions that are coming up, and I would say generally on those, whether it's something healthcare related, even housing affordability, companies are sort of still casting those as manageable. We're glad the administration is focused on this. But it really, that interest rate credit card issue is one that keeps coming back like a bad penny.
It's not going away, is it?
No.
Is that putting a dark cloud over the financials for you?
You know, what we said, we're overweight this sector and we like the sector. We think that investment banks had a problem on the valuation front, so it didn't overly worry me that first week when you saw some of them getting hit, you know, kind of more mixed results. We've liked the regionals better. We've thought generally outside of that kind of capital markets area, valuations have looked pretty good, earnings revisions have looked pretty good. But we did, you know, sort of poke holes into maybe one pillar of our thesis. And there are, you know, like 5 or 6 reasons why we like the sector. One of those had been the perception that the policy tailwinds were stronger than the headwinds there. And so we did sort of call that out after the first week. And, you know, when we wrote our recap that, you know, we might need to question that assumption.
You're right to point out some of the jitters, and some of the headlines too were sell America. The good news this morning, notable I think, is that bonds are actually rallying. Bonds are running and yields are down by a couple of basis points across the curve.
Yeah, and is this because ultimately it is having the same kind of reaction function? You know, I'm sitting here listening to Lori talking about the idea of credit card caps, and I'm thinking about the new Fed pick and the idea of easy policy. And I wonder, is the idea of deregulation and accommodation getting squishy? Right? The idea of you give with one hand, you take away from the other. You give less regulation of the banks, but you cap some of the interest rates. You necessarily lower rates at the front end, but you might shrink the balance sheet. It's sort of like, how do you understand this in markets? And right now, it's squishy.
That was Friday's story, struggling to price Kevin Walsh at the Federal Reserve. Did you have similar conversations with clients?
So look, you know, in talking to our rates team, you know, I think what they always stress, right, and they try to take kind of a middle of a road approach on this, that this is a committee decision at the end of the day. And I think they're sort of sticking with that thesis. You know, when I sort of take a step back looking at it from an equity market lens, what I really noticed was that the Russell 2000 didn't do well after the pick. And we also were looking at that after the Fed meeting on Wednesday. I have this little screen on Bloomberg set up, so I watch all these, you know, kind of different sectors and parts of the market and how they trade after 2 p.m. And we actually saw, you know, the S&P was flat, but the Russell 2000 lagged a bit, and then we saw it get hit again on Friday. And what I thought was very interesting about that was something, you know, kind of my rate strategist had said, you know, he was talking about in his market, kind of these short-term trades might unwind quickly. In my world, the short-term trade equivalent is the Russell 2000, because fast money hedge funds like to bid it up on Fed dovishness and sell it off when their dovishness goes too far and they have to take it in the other direction. I have also pointed out that beyond, you know, sort of, you know, kind of this Fed issue kind of going back and forth, they're just not cheap anymore. They're starting to get back to November 2024 highs on a couple different PE metrics, and they're not net short anymore in the CFTC data. So that does, you know, it's a space we've generally felt better about. The earnings data is looking a little bit better there. But if you were just buying the small caps on the Fed, I mean, you got your answer on Friday. What should happen there?
The Russell futures are down by another 0.75% so far this morning. Laurie's going to be sticking with us. S&P 500 futures down by 0.6%. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Vonnie for more. Hey, Vonnie.
Hey, John. Good morning. A partial U.S. government shutdown entering its third day. House Speaker Mike Johnson is hoping for a vote on funding bills today. Minority Leader Hakeem Jeffries saying Democrats want an agreement on their demands for reforms at DHS before they'll vote in favour of the package to reopen the government. NVIDIA CEO Jensen Huang saying the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. The Wall Street Journal earlier reporting the investment plan announced in September had stalled after some people inside NVIDIA expressed doubts about the deal. Huang downplaying the report, saying NVIDIA will continue to invest in the ChatGPT maker. Disney is close to naming a new CEO to succeed Bob Iger. Sources telling us here at Bloomberg the company's board will likely promote theme park division chairman Josh D'Amaro. D'Amaro has led the unit that delivers most of Disney's profits since 2020. The board is expected to vote in the coming week. Disney also set to report earnings within the hour. And that is your Bloomberg Brief. John.
Watch this space in the next hour. Who knows, we might get an update. For those of you worried about a Bob Chapek repeat, then the good news this time around is James Gorman's running the succession planning and not Bob Iger.
Yeah, it seems like right now there is probably going to be a successor, and that person is going to stick because evidently Bob Iger enjoys his yacht and wants to spend more time on it.
Why not? And the reason I mentioned Gorman is because he oversaw such a fantastic succession plan over at Morgan Stanley.
Yeah.
Ted Pick doing phenomenally well.
He just had an incredible quarter and ultimately has become chairman, and it actually is succession, not repeat, come on back, let's do this again.
What a mess,
it is,
honestly.
a mess.
More on that story in just a moment. We'll catch up with the Walt Disney story in about 17 minutes' time. Up next on the programme, gold losing its shine.
I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week.
Up next, we'll catch up with Bloomberg's Will Kennedy, live from New York City this morning. Good morning. Three-day slide on the S&P 500, developing into day 4. Equities are down across the board. We're negative by 0.6% on the S&P. On the Nasdaq 100, down by 0.9. Don't think you can overstate the importance of the story around Nvidia and OpenAI. We can get to precious metals in just a moment, but the pushback from Jensen Huang, I think, is very important.
$100 billion, as they had in a letter of commitment last September, is not necessarily an actual commitment, and they will evaluate each investment one step at a time. It raises a question, especially given the reporting over the weekend about Jensen Huang's concerns about OpenAI. Is this just the beginning of a pullback in terms of funding OpenAI more broadly, some of the more speculative investments?
It's an invitation, not a commitment. They don't need to follow through, and that's what seemed to be spooking some of the market about what is going on with OpenAI. And to your point, Jonathan, what is going on with Oracle doubling down again, the need for debt. Zero Hedge was talking about, well, this isn't just to expand their AI infrastructure, it's actually to make sure they have cash by the end of the year.
The Nasdaq underperformance so far this morning. Nvidia's down by about 1.9%. I mentioned precious metals. What a move. Under surveillance this morning, gold losing its shine.
They've paused. We know on Friday that hedge funds have reverse positions in both gold and silver, and ETF flows have been absolutely gigantic over the last several months. I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week. Once we get through this volatility, it's still going back up.
So here's the latest this morning. An explosive rally in precious metals developing into a multi-day rout. Gold extending losses this morning, at one point nearing its biggest two-day drop in more than 4 decades. Bloomberg's Will Kennedy joins us now for more. Well, I think we're all waking up and asking the same question. What happened over the previous few days, and what was this morning?
Well, I think that we quoted someone today that this trade had become very, very crowded, and clearly the precious metals rally is a story that's been developing over the last year. And it just accelerated, and I think it got to the point where it was unsustainable and some form of correction was necessary. But yes, indeed, it's been dramatic, and I think it's been particularly dramatic because both the up and now the down has been driven by a lot of retail investors coming in through ETFs and now coming out, especially in China.
Well, it's not just what's happening in precious metals, it's also base metals. We've seen it in copper as well. And this morning you're seeing it in crude. WTI and Brent down by 5% or so. Are they different stories or the same thing?
It's partly the same thing. I think that what's happened in precious has got people a little bit bearish on the whole commodities complex. But in oil, there is also the Iran in the background. There are signs that Iran and the US are talking and that they may be able to avoid a conflict. And of course, that is the biggest geopolitical risk in the oil market right now. The threats that we've heard from President Trump that he may take military action against Iran. And if those threats are off the table for a while, it's quite bearish for crude. So you've got that story, you've got the commodities sell-off, you've got the dollar playing into commodities as well, and you put that together, and that's why we've seen this quite chunky move in crude this morning.
Massive move. Crude's down by 5% on WTI, Brent's down by 4.9%. Well, just before you go, how orderly is some of this? The physical market, what do things look like? What are you hearing from contacts?
So I think we should differentiate between the gold and the silver story here. Silver has become very speculative, very frothy, quite probably disorderly, if you want to use that word, on the way up and the way down. Because the thing about silver is it's not bought by central banks, it's not held as a reserve by central banks. And what had been driving the gold rally had been, at least especially initially, central bank buying, this whole idea of central banks needing to diversify away from their dollar holdings. And I think you had a guest on earlier explaining that trend probably remains in place, and that the macro story for gold probably is still there. So I think as we look forward, we should probably differentiate between this rather crazy silver market and what's going on in gold, where the long-term stories that people have been talking about probably haven't fundamentally changed.
Well, thank you. Will Kennedy out of London on the latest moves in the commodity market. Check out silver at the lows today, just in today's session, down by 16%, and right now down about 2.9%.
The rise has been absolutely shocking. There was this one statistic that I read over the weekend that I loved. For years, silver accounted to 5 to 7% of the cost of manufacturing a solar panel. Today, it accounts to 15 to 20% of the cost of each solar panel because of how much prices have increased. How, as a manufacturer, do you price and source some of these resources if it's trading like a Bitcoin or if it's trading like a penny stock? And this is increasingly the question because it is something that people actually use.
This is why the trade was loved so much from the long side, because you had that industrial component and that precious metal component as well. But to Will's point, volatile on the upside and volatile as we move to the downside. This has been pretty explosive stuff in both directions for that metal.
And frankly, the trading's gotten a lot thinner, and there's a real question of who's going to step in and buy. And ultimately, right now, people are wondering if Chinese retail buyers are going to step in and buy the dip. And if they do, then they'll get more excited to maybe go and follow. But at this point, how can a respectable trading house put any kind of risk on the line when it's unclear what the drivers are and you've got increasingly thin liquidity?
Lori Calvasino of RBC is still with us. Lori, I wanted to talk to you about the relationship between precious metals and what's happened with equity risk, the correlation between the both, the traditional correlation and what we've seen play out more broadly in the last 12 months or so.
So when I talked to Chris Looney, our gold strategist at RBC, the thing he emphasized coming into last week was the dollar and uncertainty really driving the gold price. Checked in with him on Friday, and he said, look, we've obviously seen some volatility here, but he thinks the uncertainty story is going to stick around this year. So I think it's a question that comes up in a lot of my meetings is, why are equities ignoring X, Y, Z? And, what my response is that equities are not ignoring X, Y, Z. They are shifting underneath the surface to the sectors that might benefit from X, Y, Z, or might, shifting away from the ones that may be hurt. But primarily what we're seeing, right, is the realization of kind of that itch to sort of protect against those macro risks going to things like gold, right? I can't tell you how many times in my year ahead outlook discussions I was asked, what is Chris thinking right now? And I think the reality is you kind of do this with one hand and you do this with the other hand, right? I think that's what's been going on a lot in my world.
Do you expect a tight correlation to continue between equity risk and precious metals?
I think we have to see going forward. I think the reality is there are just not a lot of fantastic alternatives. And I do think that within the S&P, kind of that AI big mega cap tech story had been one way to play defense, right? And so when you're sort of concerned about whether it's geopolitics, macro, the economy, whatever it is, you kind of go to secular growers. Well, now are those secular growers starting to look, a little bit less attractive? So I think it increasingly pushes people outside equities to protect against those risks.
How much is all this volatility Kevin Warsh's fault?
I'm not the best person to ask on that. I tell people when I go to Europe and I go to Canada, they want to talk about the Fed. They want to talk about geopolitics. They want to talk about Greenland, all these issues. And when I come home to the U.S., they want to talk about earnings. And so, they're just very, very different focuses. To me, what I've told people is if you look at the equity market performance in different kinds of Fed rate environments, I don't have to get too caught up in this fight. We had a new component of our modeling this year that looks at how equities perform in a 12-month period when the Fed is either doing nothing or hiking or cutting by a certain amount. The best environment for stocks is when the Fed does absolutely nothing. If you look at the next two best, it's when the Fed is hiking or cutting 100 basis points or less in a 12-month time frame. So my only kind of dog in this fight is I don't want the Fed to be doing too much.
I know we don't talk about Bitcoin very much, but Bitcoin's down some 25% in the past couple of months. And I'm just wondering if that signals to you that it's correlated with precious metals, that it's correlated with something else, or that, frankly, the bubble's bursting.
Well, it's funny. I have a chart in my weekly, which we put out this morning, and I was updating this one on Friday, so it doesn't sort of show the activity over the weekend. But it had actually already shown as of Friday that Bitcoin was breaking down a bit. And then also there's this index looking at private markets-related stocks. And we started looking at that after, kind of October, November. We have a few other things on the chart, including the S&P. And what we basically show is that, a lot of these different gauges of risk all kind of broke down at the same time in October and early November. And we often can see that when Bitcoin breaks down or just, it can be not necessarily a leader of a decline in the equity market, but at least a sideways kind of move, causing some indigestion. So we watched that religiously in the weekly. And we did call that out that, you're seeing both that private markets index, which nobody's talking about, by the way. That's just not coming up in conversation these days, at least in my meetings. And then Bitcoin also breaking down. Is it sort of confirming that we need a little bit of a breather in this market?
Lori, it's good to see you. Thoughtful stuff. Thank you. Lori Calvasino of RBC Capital Markets. Up until now, the stock market quite resilient in the face of these pockets of real volatility. Crypto being one, JGBs being another. Gold, precious metals more recently.
I think that all risk assets, dollar denominated, were up last month, despite all of the headline risk. It just gives you a sense of your point.
Up next on the program, we'll catch up with Norman Rule of CSIS as the US and Iran turn down the temperature. We are on the longest losing streak of the year so far. 3 days, could become day 4. We're down again this morning by 0.5 on the S&P, negative by 0.8 on the Nasdaq 100. Precious metals also getting hammered this morning. We're down about 2 or 3% on gold. Silver recovering. The volatility in silver is just absolute nonsense. Down 16% to down 1.97.
I love this.
For no reason. Based on what we've seen.
Yeah, we've escalated from, a lot of volatility to just sheer nonsense. And I think a lot of people are viewing it that way, which is the reason why you've seen actually people pull back from trading it. What is spurring this and how much is being driven by retail investors over in China?
Well, when John's saying nonsense, this is basically the tone Paul Donovan of UBS took this morning. Has FOMO lost its mojo? Basically, people trying to spin this when it comes to silver and gold as fundamental economics. It seems more likely that the fear of missing out trade has become exhausted.
We've got a lot to track, and it's exhausting so far already this morning. Futures recovering, we're down about 0.5% on the S&P. Let's get you an update on some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. As you guys have said, the precious metals rally has come crashing down, and we're seeing mining stocks falling as a result. We're seeing Barrick Gold down 2.5% here in the pre-market. And Lisa, you ask what is driving this? Well, Ed Yardeni saying the sell-off may have started with President Trump picking Kevin Walsh to lead the Fed, but the bigger driver was the CME raising margin requirements, which forced traders to liquidate their positions. Meanwhile, Oracle shares also falling in the pre-market, down 3% as the company says it plans to raise up to $50 billion to fund its AI computing build out. Roughly half of that would come from debt, adding strain to an already heavy balance sheet. So the concern here is that borrowing more before AI profits show up could add strain to cash flow, which is already negative, and pressure credit ratings. And Bitcoin ending the month of January lower, its 4th straight monthly decline, something we haven't seen since 2018. And we start February not on a good note. Bitcoin this morning below 78,000, and that is hitting crypto-linked stocks like Coinbase and Michael Saylor's Strategy, which is down 7.5%, and it now owns Bitcoin worth less than what it paid. John.
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, gold and silver extending losses into a 3rd consecutive day, nearly unwinding their recent record-breaking rally. At one point, gold nearing its biggest 2-day drop in more than 4 decades. Elsewhere, Nvidia CEO Jensen Huang saying his company's proposed $100 billion investment in OpenAI was, quote, never a commitment. Huang adding that Nvidia will invest one step at a time, calling the potential deal, quote, the largest investment we've ever made. And finally, House Speaker Mike Johnson confident the partial government shutdown will end by tomorrow, approving the plan would fund Homeland Security for 2 weeks, allowing more negotiating time, while the rest of the government would be cleared through September.
I can just say I'm really happy that it took a half an hour for us to talk about the government shutdown that begins today, because it indicates that it's not on people's radar, which is a positive thing. And I really hope personally that it gets resolved quickly. Right now, the affected agencies are the Treasury, Defense, Homeland Security, Transportation, Health and Human Services, and Labor Departments. What about the data? Do we get the data? The labor market report is going to come out on Friday, and that ultimately, to me, is my main question.
We get it if Speaker Johnson is accurate in his confidence that we will avoid this by Tuesday. If it goes longer than Tuesday, I'm not sure we get the data, the non-farm payrolls report coming out on Friday. And I think it is a little bit more of a tricky calculus right now. There was a call over the weekend between Democratic leaders, Hakeem Jeffries and his caucus. And then he had to go tell Mike Johnson, don't count on Democrat votes for this. So it is going to be a little bit more challenging, and I don't think they're out of the woods just yet. I'm not counting on it ending tomorrow.
I was hoping to go through the whole show without talking about this at all.
Well,
never mind the last 60 seconds.
Someone just, shoehorn that in there just to, wreck your day.
Well, we might not get the data if it stays shut.
65K is the estimate for Friday, by the way. I hope we actually see the number. The previous number was 50,000. Elsewhere, let's turn to geopolitics. Crude prices falling as President Donald Trump looks to strike a deal with Iran.
Why wouldn't he say that? Of course he would say that. But we have the biggest, most powerful ships in the world over there, very close, a couple of days. And hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Iran's Supreme Leader warning of a possible regional war. Bloomberg's Jumana Basenji joins us now from Dubai for more. Jumana, good morning. Are we close to a breakthrough here?
I think that's a big question. Diplomacy is definitely back on the agenda again, John. If you compare where we were going into the weekend on Friday, I think there was a feeling that perhaps military action was imminent or possibly could happen over the course of the weekend. We walked in today and it really feels like the diplomacy angle is the angle that has been actively pursued over the last 24 hours. And a lot of the push has been from Gulf Arab nations. You know that the Qatar Prime Minister, Foreign Minister traveled to Tehran. He met with Ali Larijani, who's the Secretary of the Iran National Supreme Council. After that, Larijani posted on X that a framework for negotiations had been agreed to. They've also had calls with the Egyptians, with Turkey as well. And so really, there has been a push to bring Iran back to the negotiations table. Now, here is the question. What exactly are they going to be negotiating? Because what we understand is that the Trump administration wants to tie in three elements into this round of negotiations. It's not just about their nuclear ambitions anymore. They also want to include the ballistic missile arsenal and the fact that Iran still sit on a huge number of short and mid-range ballistic missiles. And they also want to bring in the discussions around Iran funding many of those proxies in the region, including the likes of Hezbollah and Houthi. The Iranians have said that those last two elements are non-starters at this point in time. They're willing to continue negotiations on nuclear, but not necessarily the other two. And so it is going to be interesting to see whether there is daylight between the two, whether these negotiations can actually push forward. They're not direct, as we know, they're indirect. And at the same time, the U.S. President Trump, has warned of that huge military presence, the armada that's being built up in the Arabian Sea, the arrival of the Abraham Lincoln, the F-15, the F-35, the buildup of troops in the region as well. All of that is a means of deterrence. But some people are saying maybe they're just biding time and waiting to build up a stronger presence before we actually go down the military channel.
Jumana with the latest out of Dubai. Jumana, thank you. Jumana Basechi there of Bloomberg. To extend the conversation, joining us now is the former senior US intelligence official, Norman Rule. Norm, I think Jumana's asking the right question. Negotiations. What's up for negotiation?
Well, good morning. Diplomacy continues and to remain the administration's primary goal with Iran, but significant U.S. military action is a serious near-term possibility. The nature of the U.S. force buildup and Iran's continued unwillingness to make the substantial concessions that Washington seeks bring us to a continued impasse. A U.S. military strike on Iran could begin with little notice. It is true that diplomacy dominates the landscape, but the Trump administration will not tolerate its time being wasted. Regional partners are indeed focusing on an intensive diplomatic campaign, but the Trump administration's demands have been consistent. They're harmonious with what it has been asking for years and previous administrations. Substantial concessions on Iran's nuclear weapons capability, its ability to build a long-range missile program to include an ICBM program that could threaten the United States, and regional militia programs that destabilize the region. If Iran does not concede on this, there is a high likelihood of military action in the near term.
Norman, is diplomacy then just a real option, or what you're describing it maybe, is it just a distraction tactic?
It is a real option. And I think the Trump administration has actually played this well. It has used rhetoric. It has used the threat of significant tariffs. And it has used this military buildup to produce a dynamic in which multiple countries are now pressing the Iranians to produce concessions that would achieve what all of these countries want. None of these countries want an Iranian nuclear weapon, a missile threat, and all these countries oppose Iran's regional malign adventurism. So in essence, we all want the same thing. It's just Iran refuses to cooperate. The challenge is that to do this, Iran will have to make substantial changes in the DNA of the regime itself, and politically, it's been unwilling to do so. The hope is that because of the unrest and the significant economic challenges the regime faces, that this might be a moment where the regime's leadership, in order to seek regime long-term survival, may be willing to make those concessions or begin a process to do so. So it's not an unwise tactic that the administration is pursuing. The question becomes, is there a reason to believe that it will be successful without military option? And there is reason to be pessimistic.
Well, you've been watching Iran for decades. Any evidence that they are willing to make some of those concessions?
None.
So that basically leaves the United States with likely a military option. Is that accurate?
No, it means that I haven't seen the evidence. The evidence may be classified, and the diplomatic process is still underway. There is reporting that U.S. Special Envoy Witkoff and the Iranian foreign minister may meet this week, perhaps in Ankara, and that process may produce additional pressure. The U.S. Military presence in the region is truly dramatic. It is providing the United States with a capability that Iran will understand, allows the United States a capacity for intensive multi-day air and missile capacity over virtually any part of Iran against which Iran cannot compete. So this is going to create a conversation within Iran itself, and therefore that evidence may not exist today, but it may build up over coming days. And again, that's the process the Trump administration is trying to create. So the Trump administration is not doing anything unwise. It's creating a dynamic that it hopes to achieve an end.
Meanwhile, Norm, we have heard from Iran that this will cause a regional war and warns of that as one sort of deterrent to the United States. Do you have a sense of what the region's neighbors and behemoths, frankly, think of all of this? How much is the U.S. building up troops in coordination with Saudi Arabia, Qatar, Israel, and the others?
Okay, so sure. So first, whenever this happens, Iran knows it cannot compete militarily with the U.S., so Iran threatens to disrupt the global economy, to transform this into a regional war, to use asymmetric tools. So it's fallen back on its traditional tactic. It's conducting a live fire naval maneuvers in the region, and it's trying to show that it could close the Strait of Hormuz, which it could do temporarily. The United States has responded by pushing out a vast amount of air defense to its partners in the region over the last several days to improve their protection. We would be able to clear the Strait of Hormuz. It would take some time, and how long, it depends. And of course, the partners in the region are doing what they normally do to ensure that the global energy market is well supplied, as it would be through storage, through releases from strategic reserves, so that if there were an interruption in the Strait of Hormuz, it would be temporary. And also, I should say that if Iran were to do that, it would have no strategic impact on the course of the campaign in Iran itself. So Iran just is playing whatever card it's got. It can't compete on the campaign in Iran, so it's trying to use diplomatic pressure externally to convince other countries to convince Washington not to attack.
Hey, Norm, appreciate the analysis this morning, sir. Thank you. Norman Rule there of CSIS. Crude, Brent and WTI trading lower this morning. The prospect of de-escalation between those two countries contributing to some of that move so far today. This is the story I wanted to get to. Disney, the Walt Disney Company putting out earnings. Adjusted EPS 163, the estimate 156, and the park business getting it done, which is interesting when you consider the succession planning going down at the company.
Yeah, the person who is likely to take over is the person who is running the parks division, I believe, Josh D'Amaro, who may be announced as soon as this week as the board meets to discuss who Bob Iger's replacement is going to be. This has been the leader. Very curious to see some of the other questions around the controversies and what happened with late night television and everything else that evidently pushed Bob Iger to say, I think I need to spend more time on my yacht.
The stock is just about unchanged in the pre-market so far. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
John, thanks. Yep, Disney shares falling in the pre-market. The company reporting first quarter earnings that beat on both the top and bottom lines. And Disney reportedly close to naming a new CEO to succeed Bob Iger. Sources telling us here at Bloomberg, the company's board will likely promote theme park division chairman Josh D'Amaro. Elon Musk is taking steps in a massive consolidation of his empire. Sources telling us here at Bloomberg, Musk is merging SpaceX with his artificial intelligence firm xAI. A potential announcement could be coming as soon as this week. Representatives for both SpaceX and xAI didn't immediately respond to requests for comment. Fifth Third announcing it's closed its historic merger with Comerica. The deal creating what will be the 9th largest U.S. bank with approximately $294 billion in assets. Fifth Third CEO Tim Spence saying, quote, "We are creating a stronger, more diversified bank that is well positioned to deliver exceptional value." And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the President pushing for rate cuts.
Do you have a sense of what he's going to do as far as interest rates are concerned?
I hope he's going to lower them. I hope he's going to lower them.
Up next, we'll catch up with Andrew Sheets of Morgan Stanley. Equity softer, we're down by 0.4% on the S&P, we're down by 0.75% on the Nasdaq, and down another 0.5% on the small caps. The Russell 2000 trading lighter, softer, lower, negative by 0.49% so far this morning. Under surveillance this morning, the president pushing for rate cuts.
I think he may get Democrat votes soon. I think he's so good that he'll probably get Democrat votes. He should. It's very good. My choice, my Fed choice, should get Democrat votes.
Do you have a sense of what he's going to do as far as interest rates are concerned?
I hope he's going to lower them. I hope he's going to lower them, but he's going to have to do what he wants to do. He's a very high-quality person. He should have no trouble getting through.
So here's the latest this morning. Markets looking to price a Kevin Walsh-led Federal Reserve, President Donald Trump's nominee, known on Wall Street for being hawkish on inflation. Andrew Sheets of Morgan Stanley joins us now for more. Andrew, good morning. We've said it a number of times over the past week or so. Who is Kevin Walsh? What does he stand for when he becomes the Fed chair?
Well, thanks. Good morning. It's great to be here. Look, this is something that the market is going to need to figure out. And I would say the good news so far is that the initial reaction that we've seen, I think, is the reaction you would associate with credibility, right? Over the last couple of weeks, there have been real questions around the stability of the U.S. dollar. You've seen large increases in precious metals prices. And the reaction to Walsh's nomination or the perceived nomination would be that gold prices were down, silver prices were down, the dollar was higher. So I would say that's one important factor. The second factor, though, that we have to consider is this is a difficult job in the best of times. And this is a especially difficult job now. Inflation's above the Fed's target. Mortgage rates are still higher than I think a lot of Americans would prefer, and valuations are high in the market. And so this is also, he's going to be coming into a Fed with some challenging things to navigate.
The endorsements on Friday were pretty notable. We're talking about establishment figures, defenders of the liberal order, Geeta Gopinath, Mohamed Al-Erian, the Canadian Prime Minister Mark Carney. The list just got longer and longer going into the weekend.
People really think he's good because he has the credibility of having been on the Fed, having been an economic actor for a long period of time. I just wonder if legitimate is commensurate with predictable and whether we really can understand exactly how he's going to go forward.
But also other individuals like former Secretary of State Condoleezza Rice, Jason Furman, who worked under Obama. Does that actually make it harder potentially for the MAGA wing of Trump's party to embrace this Fed chair pick?
It would be nice if we can turn the volume down on the Fed speak. And I do wonder if that's the direction Kevin Walsh is going to take things.
Rich Clarida, the former vice chair and currently at PIMCO, said this. Walsh, based on his writings since leaving the Fed, may be much less likely to rely on extensive forward guidance about the future path of interest rates, especially during normal times, as in the case today. In other words, are we watching the death of forward guidance?
Is the market already there, less reliant on the communication coming up from this Federal Reserve anyway? Lisa pointed out going into the weekend, and I think rightly so, that the story in markets has been elsewhere, away from the Federal Reserve in the last 12 months.
So I'm actually not sure it has fully moved away. I mean, I do think one remarkable factor of this year is that despite everything that's happened, kind of constant weekends dominated by big events, is that implied volatility on U.S. rates is lower than where it was on January 1st. And so I do think this fact of maybe less forward guidance, less communication, a market that I think has gotten very used to a Fed that is telling it where it's going to go, how fast it's going to get there, what it's thinking at all times. If that really is going to be a major change under a Walsh-led Fed, that would be a major shift. And we think that could support a steeper curve and higher volatility as the markets just have to adjust to this different regime.
At the same time, just to sort of build on what John's getting at here, there's a sense that right now the market rises and falls more on Jensen Huang, the central banker to the world, than Fed Chair Jerome Powell. And there's a sense that ultimately this is kind of a not boring time, but it's a time for the Fed just to sit back and do nothing. Isn't it just true that it sort of depends whether Kevin Warsh gets tested? Otherwise, it kind of doesn't really matter.
So I think that testing question, I think that's exactly right. And again, I think if we think about the market and the risks to the market environment, one would be that you see disappointment out of one of these big tech-led enterprises where the market is clearly very optimistic about the future. But the other is that we haven't yet really seen a tension between what the Fed, I think, would like to do, which is bring rates down, and the underlying data yet, right? So far, the data, even though inflation is still above the Fed's target, you still have somewhat weak jobs growth. You've had enough to convince the Fed to get closer to neutral. What happens if the inflation data remains a little bit sticky this year? What happens if there's more conflict between maybe a desire to cut rates and the underlying inflation data, or if the labor market reaccelerates, if we get stronger jobs growth again? We haven't seen that yet, and I think that would present a real test and a real challenge for the market to deal with.
What do you make of this argument that if the Fed were to allow the balance sheet to roll off more significantly, it would tighten financial conditions enough to allow the Fed to cut rates really aggressively at the front end? Do you buy that? Do you think that that is a recipe for lower rates in nirvana?
So I do think this is a real complicated path to go down because, again, I think in theory you could say, look, the Fed has different levers it can pull to ease financial conditions. If it does a lot by easing financial conditions by buying a lot of assets, then maybe it can do less at the front end with rates and vice versa. So if you're doing less with the balance sheet, you can do more with rates. I think the difficulty, though, one, I think the market is clearly very focused that it needs to be a sufficient level of reserves in the system. There's already, I think, debate about how close you're getting to that level. If you're going to run the balance sheet off a lot more than that, do you risk more liquidity squeezes in the reserves market? And I think secondly, and again, I think this goes back to the point we were just mentioning, it takes the market some time to adjust. So going very quickly from one regime to another, I think also would be a recipe for more volatility. So I think in theory it makes some sense, but I think it would be important for the Fed to use a glide path for that to give more clarity. And ironically, kind of what we're talking about here is less forward guidance, less forward looking. There's clearly some tension there.
It might be hard to go from one regime to the other if the former Fed chair is sticking around. Do you have any insight or thinking about Jay Powell, whether or not he stays on as a governor?
So we don't have a specific forecast for that. Our expectation is that he would stay until we hear otherwise. But this is another factor that I think is important for this debate, right? Unlike a lot of jobs in business, the Fed chair is presiding over democracy. He needs the votes of the rest of the committee to execute policy. And so that is a change. And I think when we talk about what would Chair Warsh want to do and how would he like to take the Fed, another part of this will be to what extent can he get the rest of the FOMC to share in that vision, to move in the same way. And I think that's also very, very important. Again, this is a reason why at Morgan Stanley we're not expecting this to represent maybe as much of a rapid shift of Fed policy because you have the rest of the Fed to move along.
We've got space for one more question. I want to squeeze this in, and you can answer it however you want to answer it. We've seen convulsions in JGBs, convulsions in precious metals and crypto. I want to understand from your standpoint whether we could see some convulsions in corporate credit this year, given what we're hearing from Oracle over the weekend.
So far, actually, I would say credit's been surprisingly calm. And I think an important factor there is that the economic data so far has been good and yields have remained elevated. And so I think the risk for credit, the way that credit does convulse, is I think if we saw much weaker economic data, if we saw much lower treasury yields that take away that yield-based buyer, I think if what the market is dealing with is somewhat higher rates, a steeper curve, because economic data is holding up, that's actually quite good for the demand story. And look, some of these companies might have to pay up more because they're issuing a lot, but I don't think it leads to those convulsions, so to speak.
Andrew, it's good to see you. Thanks for dropping by. Andrew Sheets there of Morgan Stanley on the credit markets and the next leader of the Federal Reserve.
Will he please stand up? I mean, I think that's what everybody is wondering exactly. Who is this person? And will we find out because he will put a muzzle on everybody at the Fed?
Wouldn't that be good news?
For
some people in this market, that's the world they want to see. They don't want to hear from the Federal Reserve so much.
Tell me about your feelings. I'm there for it.
End the news conference.
Exactly.
Get rid of the dots.
No, come on. I want all of it.
No more Fed show. No?
Well, that's another story.
You just want an afternoon back.
Exactly. Coming up on the program, we'll catch up with Matt Miskin of John Hancock and a whole lot more. The second hour of Bloomberg Surveillance up next.
The only thing the equity market really cares about is revenue growth and earnings growth.
We've got some enormous spend going on here.
Valuations do speak for a stretched market. There is more capex in the pipeline.
We actually think the Mag 7 is interesting again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P pulling back by 0.5%. Fourth day of losses potentially just round the corner. The Nasdaq 100 down by 0.8. In the commodity market, we're down by more than 2% on gold, by more than 2% on silver. Brent and WTI trading lower by almost 5%. Big moves to kick off the trading week. Going into this later this week, Alphabet and Amazon earnings, and then on Friday, we hope at least, we've got a payrolls report.
This morning feels like whack-a-mole. Right now, there's so many different narratives that are coming around and swirling. You start to ask, why are equity markets down? Is it because of the risk-off move that you're seeing in crypto and metals, or is it because we're seeing some skepticism around the AI trade and some of the investments in OpenAI? There is a swirl, a toxic swirl that has come together. We've seen this again and again, and yet there has been a sense that things have bounced back. With respect to the metals, there is a sense that this is a lot of speculative trading and that this is bouncing around. And what a lot of people are looking for is, when does the buying step in and solidify some of these levels that had gotten a bit bonkers last week?
Potentially, the buyers will step in if we see some more movement on the geopolitical front. After speaking to Norm Room, potentially diplomacy will not work. And then, of course, we could be off to the races when it comes to gold and silver. I love what you said earlier, though. How much of this is just basically because Kevin Warsh has been announced now at the Fed chair? And how much of that potentially is just so overdone?
I would put more weight on Jensen over Kevin at this point. Jensen Huang with some punchy comments over the weekend. It's not a commitment. A $100 billion investment in OpenAI is not a commitment, which raises a lot of questions about all the other headlines we've seen over the past 12 months.
The idea that every single big tech company is lined up behind OpenAI with huge investments. And Jensen Huang filed a letter of intent to have a $100 billion commitment, or up to a $100 billion commitment last September. Now, taking some emphasis off of that after reporting that he had been skeptical about exactly what the money was being put to use. It comes as Oracle raises $50 billion in debt and equity markets to finance its build-out. There is more skepticism getting built in, especially as the earnings with Lori Calvasina point out you're not seeing the bang for the buck yet, and that's causing some concerns.
Nvidia in the pre-market negative by more than 1% so far this morning. Coming up this morning, this hour, we'll speak to Matt Miskin of John Hancock as investors dial down risk, Henrietta Trays of Vader Partners as the government shutdown standoff rolls on, and James Steele of HSBC as the precious metals route enters Day 3. We begin this hour with stocks falling, with gold melting down. Matt Miskin of John Hancock seeing the most popular narratives as mirages, writing between run it hot on macro and the US dollar debasement for markets, both look unlikely to materialize. Matt joins us now for more. Matt, good morning. Why are you pushing back?
Yeah, we're just not seeing it in the data. If you look at the consumer confidence report, it was the opposite of run it hot. It was actually pretty cold, like up here in the Northeast right now. We're seeing the consumers are saying jobs are hard to find. This labor market is relatively weak. And then we're getting inflation data showing that inflation, if you look at Trueflation, which is just an alternative inflation source, that's saying under 1%. We're thinking inflation is moderating more than the markets think. We think the jobs market is weaker. And you put these things together, it is the other side of the boat from this run it hot narrative. We also look at this dollar debasement. Yeah, it is. The dollar's weaker than the euro, the yen right now. It is a currency war all over again. We had currency wars about a decade ago. The dollar's frankly winning right now. That's probably going to help U.S. exports. It's going to help the U.S. be a bit more competitive. But we don't see this dollar debasement helping lift all this riskier assets.
So, Matt, let's unpack this. So you're questioning run it hot, you're questioning dollar debasement, and you're short inflation. Where does that leave you on precious metals?
Not a huge fan. You know, the FOMO trade is one that you really got to be careful of. It's one of the easiest mistakes as an investor right now is to get this fear of missing out type mentality. That and trading geopolitical headlines. Precious metals to us has gone through one of the most historic runs in history. It was the sweet spot of these narratives. But we really think that you would look to trim into it, take some profits there, redeploy into higher quality assets, look for some income in this market where we still have some really attractive income to generate.
It sounds like, Matt, you like bonds. If you are going against the inflation narrative, you're going against this idea of precious metals, and you're talking about a currency war that could lead to cutting rates around the world. How significantly do you have conviction about this? Are you buying 30-year JGBs with aggression?
That's a little rich for my blood, Lisa. But the JGB move is one that is, pretty significant here. A lot of volatility off of very low yields still. In the U.S. here, we still have some really higher yields. We never got yields to come down that much. And then we've got this nice roll down now going into 2026. So before, you always had to fight the short end of the curve. The yields were so attractive, but that's been chopped down, and it is likely still to get chopped down this year. So the 10-year part of the curve is our favorite part. The roll down into the short end looks really attractive. We've got, real yield, for retirees that we work with. If you can get some real yield, rewind 10, 15 years ago, you couldn't even get that for investors. So we've got real yield. We're looking at mild credit. Investment grade corporates is about as risky as we're looking to get here. Really underweight high yield. But look, there's other things you can do in the equity space. You can take some risk there. In the bond market, you're not getting paid for that additional risk. Intermediate, relatively high quality. Keep it boring. Bonds look attractive here.
Matt, how much is this call underpinned by an idea that we are seeing some froth come out of the AI trade? The idea that people are going to be looking for safety outside of equities after the big driver of so many of the gains kind of loses steam.
Yeah, it's like a one-legged stool in terms of the U.S. equity market and economy. Just the AI momentum was so massive in 2025, and we think it's going to be hard to replicate in 2026 on top of a massive level. And I get it. There's great businesses there. They've grown earnings well. But we are looking at more of the mid-cap space. Quality value is our mantra in looking at equities across the world. Industrials are a place that have high return on equity. They've got an earnings growth story here. The one big beautiful bill will help some of the capex accelerate into 2026. But we're looking to, navigate that and kind of just, move away from it, find other parts of the portfolio. Investors have never had so much equity exposure and consumer net worth as they do today. And consumer net worth is $173 trillion. We're in the most concentrated stock market in history. Our biggest job as a asset allocator is finding better opportunities or opportunities that can pound for pound meet what the U.S. equity market and large cap and tech have done for investors over the last decade.
Matt, when you say move away, is it because you think it's a bubble or you think it's just overdone?
It's overdone. And yeah, the valuation's just, you're tapped out. It's going to be hard to generate returns out of the multiple expansion anymore. You already got it. Now, earnings growth is the last engine of return. And look, it's still on. That engine's still going, but that's the last engine you have. And we think that's going to moderate. If you look at the analyst estimates, it peaks out on a year-over-year growth rate in Q2 and then starts to moderate. One of the things we are learning here in the markets over the last 12, 18 months is the second derivative. So in Europe, for example, if you go from 1% growth to 2%, the market is in love with that. Well, if you go from 20% to maybe 15%, maybe the market won't love it as much. And you do get these days where you get this kind of reaction function. John was talking about, the issuance of debt here over the weekend, concerns about the liquidity or the funding of some of this AI investment. You can get a pretty quick turn. So we want to find other things in the portfolio that could step up when AI starts to slow down.
And as you see inflation moderating, do you think that potentially a more dovish Kevin Warsh shows up to the Fed when he gets confirmed?
Yeah, we do think that ends up happening. And look, right now, the Fed is in a really tough spot. You look at the beige book, right? So there's quantifying ways of kind of looking at the beige book. So this is how the Fed kind of asks businesses and consumers how things are. And it's all over the place. The line is just like, up and down, up and down. 1 second, it feels like we're in a recession. 1 second, we're feeling like we're great. Back and forth, back and forth. And it's really hard. Well, we think in about 3 to 6 months, we're going to get through all this kind of macro turbulence, and we're going to end up seeing where we finish out. And in our view, we're going to be at this kind of back to pre-COVID normalization, relatively low growth, 2% inflation. And in that world, it's lower interest rates. We're lucky right now. We still have that higher interest rates. That's why we want to take advantage of it. But we think in 6 to 12 months' time, we're kind of back to this low growth, low inflation world, and yields will likely come down with it.
Matt, thank you, sir. Lots to think about after this appearance. Matt Miskin there of John Hancock. So let's take a step back and give it 60 seconds or so. Consensus view sounds like this. 3 pillars of a better outlook. You've got easing fiscal, easing monetary policy, and massive tech capex support in this market for as long as the eye can see. Matt Miskin's coming out and questioning a couple of those pillars and saying, I'm short inflation, I'm long bonds, and I don't like the move in precious metals.
He's saying we're not seeing some sort of breakout in any kind of growth. And frankly, we're not seeing ongoing investment in AI that continues to the same pace that we've seen. And frankly, he thinks that it is overdone and that you do have elevated valuations. So you take away those pillars and suddenly you're left with bonds. And that seems to be his aggressive call right now, at least in the United States.
You're down a single basis point on 10s this morning, 422. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Donald Trump is planning to close the Kennedy Center for about 2 years for renovations. The president's decision coming after he faced significant backlash to his renaming of the center to the Trump Kennedy Center. Many prominent artists have since cancelled performances and ticket sales have been on the decline. Shares of Oracle trading lower in the pre-market. They've reversed now, trading higher, in fact. The company planning to raise $45 to $50 billion this year to build additional cloud infrastructure capacity to meet demand. Its largest cloud customers include Advanced Micro Devices, Meta Platforms, NVIDIA and OpenAI. President Donald Trump expected to adjust a critical minerals stockpile, to launch one even, with $12 billion in seed money in a bid to help protect manufacturers from supply shocks. The venture, called Project Volt, is set to merge nearly $2 billion in private capital with a $10 billion loan from the U.S. Export-Import Bank to secure minerals for manufacturers. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, Speaker Johnson's shutdown strategy.
Let's say I'm confident that we'll do it at least by Tuesday. And because of the conversation I had with Hakeem Jeffries, I know that we've got to pass a rule and probably do this mostly on our own. I think that's very unfortunate.
Up next, we'll catch up with Henrietta Trays of Vader Partners, live from New York City this morning. Good morning. Things improving slowly. We're still lower across the board by 0.4% on the S&P, by 0.75% on the Nasdaq. If you're just waking up and tuning into this, check out precious metals, gold and silver. This is child's play. The stuff we saw earlier was absolutely ridiculous. Overnight, double-digit moves in percentage terms on silver, massive moves in gold.
Yeah, the biggest two-day move in silver, if you count Friday's session, on record. The biggest two-day drop for gold going back to 1980. Still, though, when you take a look at how far some of these precious metals have run up, you would still be up on the year if you bought at the end of last year. So there still is froth to be taken out, and that, I think, is what a lot of people are looking for.
47.61 right now on gold. Under surveillance this morning, heading down to Washington, D.C., Speaker Johnson's shutdown strategy.
There's a lot of details in this. We could get deep in the weeds, but we will do that over the next 2 weeks. I think we're on the path to get agreement, and I really hope that everybody will come to the table in good faith. Well, let's say I'm confident that we'll do it at least by Tuesday. We have a logistical challenge of getting everyone in town, and because of the conversation I had with Hakeem Jeffries, I know that we've got to pass a rule and probably do this mostly on our own. I think that's very unfortunate.
So here's the latest this morning. The House racing to end a partial government shutdown without Democratic support for DHS funding. Bloomberg's Lauren Dzenski joins us now for more. Lauren, welcome to the programme. Can we avoid all of this? Because I tell you, from Wall Street's perspective, they care about one thing. Can we get payrolls data this coming Friday?
Well, we know at least that we are currently in a partial government shutdown. It looks like they will secure a deal to reopen the government. It looks like possibly Tuesday is what Speaker Mike Johnson said. But the big real sticking point is over this resolution on immigration raids and this impasse over immigration. Democrats really are concerned and dug in about trying to really push the administration and the government really away from funding Department of Homeland Security. And Mike Johnson sounded confident about the 2-week runway to negotiate immigration issues, but the Senate would certainly beg otherwise. They spent months trying to hash out a deal years ago, and that was scuttled entirely. So where and how the government can move forward on this incredibly tricky issue is a little bit difficult to see.
But Lauren, can Speaker Johnson actually get through just the funding package on Republican votes alone if not a single Democrat is willing to sign up for it?
He's already said that he's looking for goodwill from Democrats to make it happen, essentially indicating that he will need some Democratic support in some way, shape, or form to then at least kick off this 2-week process. So I think he's kind of appealing to goodwill here. Yesterday on Meet the Press, he said that he sees a path forward and kind of offered some olive branches that I think he's really counting on Democrats, some sympathetic Democrats to come to his side.
Lauren, appreciate your time down in Washington. Laurie Tazensky there. Joining us now to continue the conversation, Henrietta Trace of Vader Partners. Henrietta, welcome. Can we find an off-ramp here?
I think we can find an off-ramp for now. We have until Tuesday, as the speaker suggested. They're going to try to move things forward tonight around 4, 5, 6 o'clock. I would say for investors, you brought up the BLS data. That's huge. There's also the IRS funding that lapses, and it's tax filing season now. But when I travel around and talk to investors, one of the questions I get a lot is, what's happening with the president's $2,000 rebate check? Are we going to get that for the tariffs? And I would encourage folks to think about the fact that we just ate all of January up on this conversation. It fell apart at the last minute, and now we need to spend all of February basically dealing with the same government funding bills and then a DHS package, and then we'll have the State of the Union. It's basically already March, and it's only February 2nd. So for the investment community, it's really focus on what will not get done, because we're not doing this. We're not getting a second reconciliation bill. We're not getting movement on other items that the president talks about quite a lot.
Well, it seems like Leader Chuck Schumer, senator from New York, cut a deal at the White House, but it doesn't seem like Minority Leader Hakeem Jeffries in the House was privy to that. How big of a gap right now is it between the Senate leaders for the Democratic and the House leader from the Democratic Party?
Yeah, there definitely is a gap, and you can tell because there's not a vote for the rule as Speaker Johnson laid out. I think the disconnect between Jeffries and Schumer is unfortunate. It will ultimately be bridged. You saw the guys right behind Jeffries, Jim Clyburn and Steny Hoyer, saying that they're going to provide the votes for this package, encouraging their members to vote yes. So I think a lot of this also is to do with what we went through back in the original shutdown, which is really propping up potential Speaker Jeffries in advance of the next midterm election cycle, giving him an opportunity to really stake the ground, get more recognition, leadership from the conference on the House side. And I think that's what this is really functionally about.
Okay, so if Speaker Johnson can find the 218 votes and we get back to the government operating as normal and we get the BLS data on Friday, they still need to figure out the DHS funding. They're going to have 2 weeks to do that. Do you see a deal for that new bill potentially that has to be drafted?
Man, I mean, they don't even agree on whether or not ICE should be wearing masks or have name IDs. In the wake of the shooting in Minnesota, that was just a really immediate thing that Democrats gravitated to. I think you see it out in the ether as well if you talk to folks in Minnesota or anywhere else in the world where ICE has been inserted into these cities. They talk about the masks and they talk about IDs a lot, and video cameras as well. Getting early messages that Speaker Johnson's not going to agree to those three components suggests that we're in for a very rocky ride over the next 2 weeks. I'd be shocked if we were able to pull it off without having this bleed into, another 2 weeks.
Henry, I have to say, none of us sound excited about talking about a government shutdown. Pretty much, you can just feel the pall of exhaustion fall over the conversation as soon as you say the two words, government shutdown. I just wonder if we're moving to a phase where we can stop this kind of piñata or this kicking the can down the road where we're always talking about this. Maybe it's 2 weeks, maybe it's 1 month, maybe it's 2 months. Are we going to get out of this, or is this the path of travel for the foreseeable future?
I think welcome to a midterm election year. Look at some of the special elections that just took place. There's one in Texas where the swing was 31 points away from Donald Trump. And I think what Democrats learned in October is that as long as they can steer the message, they're winning elections. So I don't see a reason why this would necessarily stop. The good news for investors is that once we get BLS done with, it will be done with all the way through September 30th. So we can talk about DHS, but it won't necessarily be, hey, when we get the employment report, hey, is the IRS going to be able to process refund checks? And investors can sort of tune out a little bit. The immigration narrative in an election year, I mean, come on, that's a tale as old as time now.
There's a sense also that maybe President Trump is looking for more concessions when it comes to not just getting the budget through, but also getting his new Fed chair picked through. And there is the potential for maybe the lawsuit to be dropped against Fed Chair Jay Powell about the renovations. I'm just wondering how realistic you see that process in being stymied, whether you do see a potential path to get Kevin Warsh as the Fed chair by May.
You know, I've been working with Senator Tillis's staff for a really long time now. They have very high conviction. I do not think he is messing around. When he says, I want this case dropped and I will block all other nominees and all other considerations at the Fed, you should take that very seriously. So he's going to need to get that concern addressed. We have many months before we actually need to replace Jay Powell, and they're going to probably take all of those months. The president will have to capitulate. We saw the markets respond sufficiently to give him a message that he needs to drop this lawsuit. Jay Powell delivered a very forceful rebuttal to that in real time, as we all saw from that video. I would take that incredibly seriously. I don't think Senator Tillis is going to get rolled on this in any way, shape, or form. He's just getting louder, if anything else. So I think they will need to address that. It'll probably take some time.
And he made that point when he joined us on Friday, Henrietta. But once the DOJ investigation does get wrapped up, and once likely Kevin Warsh gets through his Senate Banking Committee, how does he play on the floor? Do you think Democrats vote for him as Fed chair?
I think so. I think you'll have a lot of aisle crossing. I think that is generally the direction of travel here with this particular nominee. You probably would have seen much fewer votes, maybe even a 50-50 split on a Kevin Hassett, for example. But judging by the temperature of what I picked up this weekend from staff on the Democratic side, there are going to be some lingering questions. There's a lot of random stuff in there. But as somebody who's already been in a similar position, has already gone through these approval processes, I think that he's on a path to getting bipartisan support.
Right. In 2006, he had a voice vote, and he pretty much sailed through unanimously to join the Fed. And Henrietta, I just wanted to end on this point because you sort of mentioned it earlier. What went on in Texas over the weekend? I know it's just a state Senate seat, but how this Democrat won in a plus 17 Trump district when he was outspent and outraised money-wise, is this a harbinger, do you think, for the midterms, or is this just a special election?
It is a special election, but the midterm cycle and this pre-midterm that we're in right now, we've been in since November, is highly predictive of electoral outcomes. And one of the things that I've been concerned about for Republicans all year is their effort to redistrict. Redistricting is all fine and well. You do not do that in a wave year, because Dems have already wiped away the potential advantage. I think it's one seat here or there that you might see any kind of plus up versus what was happening when we started this year. Now you're looking at a wave election. They diluted their districts, so they're not solid red anymore. They tried to eat into some of the blue spots. If you're getting a plus 31 in the Dem favor trajectory in a state seat in Texas, you got a problem. So the primaries, I think, are really fascinating to watch right now between Cornyn and Paxton, for example. How that's going to play out and what it's setting up for the general, I think, is going to be really exciting for anybody who cares about elections to watch. These are big swings we're talking about.
Henrietta, thank you. Appreciate your time. Henrietta Trace there of Vader Partners. Do you remember how ridiculous it was when we were confirming Powell to a second term? Elizabeth Warren called him a dangerous man. Yeah. I think Democrats at the time were obsessing over diversity and had little interest in the thoughts of the people that are actually nominating to the Federal Reserve. It was a kind of crazy time 4 or 5 years ago as well.
Yeah, it seems like right now it's going to be a very different conversation where it's going to essentially be down to, do you think that the Fed is an independent body? Great, cool, let's go. I mean, that's essentially where we're at.
I know, but I think it's still going to be quite testy when it comes to Kevin Warsh. You already heard what Elizabeth Warren had to say. She's not excited about this pick from the Trump administration.
She's excited about any pick.
True, but I don't think it's going to sail through like, say, he did in 2006, which was unanimous.
If Powell's a dangerous man, I mean, like, you know,
Kevin Warsh has his finger on the
Kevin
nukes.
Warsh is going to have a great time with the senator from Massachusetts when that hearing takes place. Coming up on the programme, James Steele of HSBC with some big moves in precious metals. Recovering here, stocks are lower by just 1/3% on the S&P 500. Massive moves in Asia. The Korean Kospi, the South Korean stock index, which had been absolutely flying year to date, up by more than 20%, was down 5 percentage points. overnight. Futures pulling back on the Nasdaq, we're down by about 0.6%. But I have to say, relative to what we've seen elsewhere and what you were seeing in the European session and Asian session too, no drama. In the bond market, 2s, 10s, 30s shaping up as follows. Bond yields on 10s down not even a basis point at 423. And in precious metals, a picture of calm relative to what we saw earlier on today. Gold and silver down by 1 to 2%.
Yeah, earlier it was 10, 11% declines in silver. You're seeing some of the biggest declines on record for both gold and silver, but it comes after some of the biggest gains on record for gold and silver. And it just raises this question, what is it telling us? If you listen to gold, what is the message? And ultimately, people are saying, well, it's volatile, it's speculative, but there isn't a clear signal yet, not yet.
We have seen these pockets of volatility. I keep going back to it. JGBs, you mentioned crypto. We've seen it in precious metals. We're seeing it now in things like energy, Brent, WTI. It hasn't spilled over into the equity market. Daryl Cronk's going to join us later in the next hour. And I think that's a big question. Why is rate vol still so low, given these explosive events elsewhere? And why is equity vol, given everything we're talking about, still so low as well?
Especially if there is a fundamental question to the AI trade that potentially is part of the crypto and the metals and the oil. And that's something that people are raising as well. To the rate volatility story, it is fascinating. I feel like people have just been, sort of stunned into silence and calm because there have been all of these different pistons that are firing at different levels, and they're firing at different times, and they're all kind of evening themselves out. People don't have a sense of where the economy is going, and I think the numbers aren't clarifying that because we might not even get them on Friday.
10-year bond yield's just about unchanged, 423. Payrolls due on Friday. Let's hope we get the payrolls report. As we count you down to the open and about 2 hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Disney shares have been flickering between gains and losses, though we are up about 1% now this morning as its Parks and Cruise division delivered record results in the first quarter due to higher spending and higher attendance. That unit is run by Josh D'Amaro, who, of course, we have reported could become its next CEO as the board closes in on a decision, which seems like a logical next move given the outperformance of this unit and it's the company's biggest profit engine. Meanwhile, the precious metals rally has come crashing down, but as you guys just said, it has been easing as of late, though we are still seeing Barrick Gold down about 1%. Newmont now up 1%, speaking to the volatility that you guys have been talking about. A lot of questions around what's driving this. I look forward to your interview with Mr. Steele. And we end on NVIDIA. Those shares are lower, down 1% in the pre-market as CEO Jensen Huang tempers expectations around AI investments. Huang saying that NVIDIA's proposed $100 billion investment into OpenAI was, quote, never a commitment, signaling a more measured approach. And it's all about timing. This comes at a delicate moment for tech, given all the questions around the big AI spend. And of course, that means that Alphabet and Amazon may face increased investor scrutiny this week when they report. John?
Yahara, thank you. Thanks for the update. The stock is lower by about 1% in the pre-market. On our radar this morning, Disney earnings beating analyst estimates on both the top and bottom lines. The company's board is close to promoting theme park division chairman Josh D'Amaro as CEO, as Bob Iger announces plans to step down before his contract ends. Elsewhere, Oracle shares reversing earlier losses. The company announcing a plan to raise up to $50 billion this year. The company also looking to expand its cloud infrastructure capacity as AI demand grows. About half of the funding will be in debt. That stock is up by close to 4%. And finally, Coterra and Devon Energy announcing one of the largest oil and natural gas deals in years. The two companies combining to create a U.S. shale producer with an enterprise value of about $58 billion. The all-stock transaction expected to close next quarter.
We've seen an ongoing consolidation in the shale patch, and I am curious how much this is trying to get scale ahead of any additional supply coming from Venezuela or elsewhere, and the fact that oil prices have come down so much. What you have seen from some of the larger companies in the oil space is efficiency, is job cuts, is all of these technological advancements. How can you do that unless you have the scale and you're seeing a remedy to that increasingly?
The best part of the Permian Basin is called the Delaware Basin. And both of these together, their assets could come close to 1 million barrels a day or net acres. For these two companies, that means together they can actually maybe start to fight up against the likes of Exxon or Diamondback Energy. It could be a lot more powerful, maybe if they want to, say, do some exploration in places like Venezuela.
If you're tracking the energy story elsewhere, we are trading softer. We're down by about 4 to 5% on Brent and WTI. I want to stay on top of commodities. An explosive rally in precious metals developing into a multi-day rout. James Steele of HSBC writing the bull market appears entrenched but has limits. Prices may eventually volatility recalibrate lower. James joins us now for more. Jim, good to see you.
Hello.
Second time in about a week, we need to pick up on some of these moves. Extreme volatility. I think it's fair to use that word in silver. Seeing something similar in gold. How would you characterize the price action of the last 12 hours?
Well, I think you've got to look at what was happening last week and into throughout the weekend. Any commodity that moves in a parabolic fashion, the way gold and silver did, really invites volatility and invites profit taking. You know, there's been a lot of fresh money injected into the market. There's always a steady audience for gold and silver. But since August last year, and really at the beginning of last year, we saw new entrants come into the market in a bigger way, not just in the US, but globally. And a lot of them may invite more volatility. They can leave as quickly as they got in. And when you get a drop, it can put some scare into the market. And you've got to forget, you've got to remember rather that this sudden rally, it hasn't been reversed, but it has been dented. And when we got the news about Kevin Walsh, which was very welcome to the market and therefore took some risk out, that's really what started this. And it fed on itself. The liquidity wasn't great, which made the decline even more so.
Are the tailwinds still in place, or does Kevin Walsh compromise the story?
Well, I think anything that brings stability that is positive will calm the gold market down a little bit. It's a safe haven. It's a portfolio diversifier. Now, what we've got to watch out, I think you made a good point about equities. There's a significant amount of buying in gold is agnostic to the price move because it's as a hedge to the equity markets. You know, managers, asset managers, portfolio managers, they have to be in equities. They don't have any choice. But they do have a choice about whether they hedge or not. And gold consistently has shown itself to be a superior portfolio diversifier. So if we got a further pullback in equities, and I'm not saying that we will, please don't think that. But if we were to, then typically you get liquidation following in gold. Gold doesn't go up necessarily because equities go down, because what can happen is that those who hold it as an insurance policy will liquidate it to raise cash. So you get a secondary impact on the gold market, but that's because it's behaving in the function and for the reason that you bought it for.
Jim, you've been covering commodities for a long time. How much has the composition of the buyer base of gold and silver changed over the past couple of years as an increasing number of hedge funds look to gold as a diversifier away from equities, as you see an increasing speculative bet in these particular precious metals?
Yes, effectively, it's a much broader church now in the gold and the silver markets, more in the gold. Gold's one of those things. It's rather like the weather. Everybody talks about it, but a lot of people don't know a great deal about it. But we've seen veterans in the market year in, year out, and lately that's getting a lot broader. And that's because it is a good portfolio diversifier. A lot of times you can't explain certain moves in the financial markets, and it leads one into gold. But I think what started this gold rally in its present genesis was the elevation in geopolitical risks in 2022 with the invasion of Ukraine, because not too long after that, we got a spectacular amount of central bank buying. If you look at it this way, up until last year, for the three previous years, almost 1 out of every 3 ounces of gold that came out of the ground went into a central bank vault. So why shouldn't the market have rallied? And that, I think, is the key. And they remain, they didn't buy quite as much last year, but they remain good buyers.
So I guess another way of asking this is, has the central bank buying been entirely priced in? Have some of the stable, dependable buyers of gold already been priced in, given how much the precious metal has rallied? And now the speculators are just pushing it up into potentially riskier territory.
I think that's a good point. I think everybody realizes that the central banks are in the market and are likely to stay in the market. And that's why we would think that any further sharp decline in gold would probably bring more of them back in. I don't know if you can say it's going in, the more recent buyers are highly speculative. I think they're just reacting to events. What we've seen is an elevation in geopolitical risk. And years before, and this is a change in the gold market, if you think about, for example, the Gulf War, Iraq invades Kuwait, oil and gold jump, Iraq is expelled from Kuwait, oil and gold go right back to almost to the dollar, to where they were before. But in the last 5 or 6 years, gold has not given back the gains it's made on geopolitical risk. It's kept a portion of them so that when the next event occurs, the market goes up from a higher base. And that's why we've been able to build, because the risk atmosphere is elevated.
But James, this recent drop over the weekend, how much is that because Iran and the United States seem willing to try a diplomatic avenue before Trump potentially weighs military options?
Well, I think that's part of it. We got Walsh, and then we got some relaxation on the geopolitical front, and they both came together at a time when a lot of buying had suddenly come into gold, and the combination there triggered a lot of liquidation and profit taking.
Can we just finish on your price target for gold? So gold at the moment is 47.83. Where are you at over the next 12 months?
Our average for the year is very close to that. And our range is about 3,950 to 5,500.
Has it ever been that wide, your range?
No.
What makes it so wide now?
The volatility and
so
the amount of money that can come in and out of the market.
This is going to be a feature of the next 12 months, this volatility.
Oh, I think so. I think we're at a permanently higher level than we have been historically. We're likely to, I'm not saying we're going to stay at this dollar level, but it's going to remain higher than it has been. We're making moves in a day that was the absolute level of gold when I first started. I know I'm aged, but shortly after our victory in the Boer War is when I started looking at the gold price. But the gold market had an absolute number of several $100s, below $500 when I first started covering it, and now we're making those moves in a few days.
How do you think Gordon Brown feels?
Well, as a Scottish Presbyterian, I was all for him when he came in, but
sure.
that wasn't maybe the best call.
No, James, it's good to see you. Thank you, sir. James Steele of HSBC. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A big win for the Democrats in Texas. Taylor Remmett winning a special election for state Senate and flipping a reliably Republican district that President Donald Trump won by 17 points in 2024. It's a race viewed as a bellwether for next year's midterm elections. Waymo is aiming to raise about $16 billion in a financing round. That would value Alphabet's autonomous driving unit at nearly $110 billion. Sources telling us here at Bloomberg the company will provide about $13 billion, while the rest will come from outside investors, including Sequoia Capital, DST Global, and Dragoneer Investment Group. Tough news for those of us ready for the weather to warm up. Punxsutawney Phil saw his shadow this morning's sunrise in western Pennsylvania today, here on Groundhog Day. That means 6 more weeks of winter rather than an early spring. A silver lining, though, Punxsutawney Phil, he's right just 35% of the time. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. Up next on the programme, pricing at Walsh-led Fed.
His history is that of being somewhat hawkish. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May.
Up next, we'll catch up with Mark Shaw, the former Chief of Staff to former Vice President Mike Pence. Live from New York City, you're watching Bloomberg TV. Woke up this morning around 2 a.m. Eastern Time, checked out Bloomberg Anywhere. Markets falling out of bed. Several hours later, this. Futures down by a third of 1% on the S&P. Things are calm. We're down about 0.6 On the Nasdaq, things are calmer. In the bond market, 2s, 10s, 30s shaping up as follows. Yields just about unchanged on the session now, anchored at the front end. On the longer end of the curve, down by not even a basis point. In precious metals, wild swings. Double digits in percentage terms on silver. Silver now down by not even 2%.
This reminds me, actually, when we were in Davos and we were having conversations with people outside of the U.S. and they were saying, oh, my goodness, the world is falling. Look at all of these headlines. Everything has changed. And then we talk to U.S. investors and they say, ignore it. It's noise. Just take a look at this. And it's just essentially much more stable. You're seeing that kind of behavior play out in markets in real time.
Equities recovering very quickly. We're down by about 1/3% on the S&P. Under surveillance this morning, pricing a Walsh-led Fed.
His history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates. And he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets. At the same time, he's been aligned with President Trump and the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May.
So here's the latest this morning. The future of the Federal Reserve in focus as investors anticipate policy changes once former Fed Governor Kevin Warsh returns to the central bank. Joining us now to discuss is Mark Short, the former Chief of Staff to former Vice President Mike Pence. Mike, welcome back to the programme. Let's go through some of the details and some of the endorsements we've had over the past few days. Geeta Gopinath, Mohamed Al-Erian, the Prime Minister of Canada, Mark Carney, and the list goes on and on and on. Is Kevin Warsh a pretty conventional Republican pick to lead the Federal Reserve?
Look, I think he is. He's somebody who's been on the Reserve before, and I think that of the options, it's a pretty strong pick for the president. I know there's some people who question, what these hearings are going to be like when he gets there because of positions he took against quantitative easing after the financial crisis and reconciling that with a very dovish approach now. But look, if the Senate can confirm Tulsi Gabbard to DNI and Kristi Noem to DHS, I don't think it's going to be much of a challenge for them to confirm Kevin Warsh here to the Fed.
Mark, you were in the room in Trump 1 when the debate was going on and who Trump was going to pick, and he ultimately landed on Mnuchin's pick of Jay Powell, which I know was not VP Mike Pence's choice. What do you think went behind this process, why Kevin Warsh was picked and not the other Kevin?
Well, look, I think there were basically three finalists in the last go round. There was Jay Powell, there was Kevin Warsh, and there's John Taylor. And I think that there were different camps aligned with each. But the reality is that Steve Mnuchin made the appeal to the president. Then when the president asked, he said, who's going to keep rates lower? And Mnuchin was clear in saying it would be Jay Powell. And I think that's what the president was looking for. It was less of a question about sound monetary policy. It was a question of who's going to push for lower rates. And, there's an irony, of course, now that the president is upset with Jay Powell for not having rates lower. But I have to believe that there's been, that same conversation has repeated itself this go round. And I think there's probably been assurances that Warsh is going to adopt a dovish approach here.
But that's why it's so precarious, given the fact that when he was at the Fed, he actually was calling for a hawkish, tighter monetary policy. Do you think his views have truly evolved, or is he just trying to be politically correct in the moment to get a job?
I don't know that I can put myself in his shoes and know that. I think that I do think he has certainly the credentials here. Again, as I said, of the options, I think there's probably a lot of comfort on the street and comfort in the Senate that this is where the president landed. And he is going to have to address the apparent change in position from where he was after the financial crisis to where he is today. But nonetheless, I think that he's going to have a term that's going to extend far beyond President Trump's term. And so he perhaps is playing a long game here, too.
Mark, I'd love your take on what we heard from Tom Tillis, the North Carolina senator who seems to not care at all since he's not running for re-election and is going to block the process until the DOJ lawsuit or complaint against the Fed is lifted. Do you think that he has more popular support among sitting Republicans than he did maybe a couple weeks ago, not just with this, but in general?
He probably does. I think there are others who are applauding some of the positions he's taking, but feel they can't take the same because they'd be concerned about their own reelection options. But, I I think that as it comes to, he's going to block this until the investigation is concluded on Jerome Powell. I think most people assume the investigation of Jerome Powell is less on the merits and more an effort to pressure the Fed to lower rates. And so at the end of the day, is the White House going to say, we're going to continue the investigation, or we're going to say, hey, we've got our own guy now to run the Fed, so let's pull back on the investigation? It seems like at the end of the day, it seems to me that this is not something that's going to continue into next year, as potentially the president suggested, on Air Force One the other night. It seems to me there'll definitely be a desire to pull back on the investigation to allow this to move forward.
I guess I was getting at something bigger, especially because we are in midterm year where we're going to be getting a government shutdown evidently every 2 weeks. And I'm just wondering, Mark, going forward, at what point you start to see Republicans look at either distancing themselves from President Trump's policies? Are you seeing any groundswell of that, especially after the special election in Texas, after the midterm outcomes? Are you seeing anything like that, or is it sort of a case-by-case situation?
I think it's more case by case, but I think it's going to continue to ramp up, I would say, over the course of the year. And it's not just Texas. I mean, there's been a series of special elections in deep red states of Mississippi and Georgia in which Republicans have been defeated. And so there's clearly a trend building at this point. And there's no doubt that other Senate Republicans are recognizing that. However, they also know that the president has enormous sway over the base, and particularly in primaries. And so I would look to see more Republican senators distance themselves after you get through primary season, but being reluctant to do so until they've secured their nomination, and then that's behind them. So yeah, Tillis is in a different position. I don't anticipate you're going to see too much more of that in the short term, but perhaps toward the summer months, I think as members look toward the general election in November and they're behind their primaries, that's when you'll begin to see more members begin to perhaps take positions similar to Tillis.
Mark, on a final note on Kevin Warsh, the president spoke at a dinner over the weekend. I'm reading a quote Washington Post had. Someone in the room actually said to me, all of this is accurate. Quote, if he doesn't lower interest rates, I'm suing his ass off. And then the president says, I'm kidding. Mark, do you think he's actually kidding, or is Kevin Warsh potentially going to face the same fate as Jay Powell if he doesn't lower interest rates?
Well, I think he would face the same fate if he didn't lower interest rates. But again, I think this process has played out for a while. It's pretty hard for me to see that the president would not have moved forward with this nomination unless he had pretty strong assurances that Warsh was looking to lower rates when he got there. And so yeah, I think he would, if he didn't, I think he would face the same pressure from the president. I think the president's somebody who likes lower rates for lots of reasons. He made his resources in real estate. The president believes that it's better for exporting and for manufacturing base if the dollar is depreciated. And I think he knows the impact on equity markets when rates are lower. And so I think he wants to continue to push for that agenda, regardless of who the personnel are inside the Fed.
Hey, Mark, thanks for making time for us. Mark Short there, the former chief of staff to the former vice president, Mike Pence. I'm intrigued by the Druckenmiller nexus, legendary investor, and the extent to which we could see Bessent and Warsh work well together over the next several years.
Yeah, with Stan's guidance.
I'm not implying anything like that. That's not where I was going with that.
Some sort of insider trading, but the tutelage of Stan Druckenmiller coming very much to the government near you.
That was better framed towards the end. Coming up, Daryl Cronk of Wells Fargo, Jason Thomas of Carlyle, Andrew Holmhorst of Citi, Oksana Aronoff of JP Morgan Asset Management. The third hour of Bloomberg Surveillance up next.
Of the four candidates that were out there, I would say that Warsh was probably the worst.
I expect him to be tested in the same way that markets tested every single central banker.
This is going to be a very interesting confirmation process.
I fully expect that Kevin Warsh will get through eventually.
What's going to be more important is how the economy evolves.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores look like this. We're negative 0.5% on the S&P 500, down by 3/4 on the NASDAQ, on a 3-day slide on the benchmark. Will it become day 4? In the bond market, yields just about unchanged throughout the session. In commercial, in the precious metals part of the market, anything but unchanged. Precious metals all over the place. Silver down by 16% at one point. Now we're down by 4. Gold's down by 3. I can't keep up. 47.51 on gold this morning.
The volatility has been absolutely incredible. The records we've ever seen when it comes to some of the dips in silver, and frankly, the biggest decline for 2 days going back to 1980 for gold. James Steele was just talking about the composition of the buyers of gold. It had been central banks. It had been these stable, reliable buyers. Suddenly, every hedge fund under the sun is turning to gold as a diversifier away from equities. And then you get speculators on top of that. And suddenly, the volatility is here to stay. And that, I think, is something we could see for the foreseeable future.
He's got a massive range for gold for the next year or so, a range of 3-something thousand to up to 5K. And I asked him, has your range ever been that wide before? And he said, no, this is going to be a feature of the next 12 months. Tons of volatility with a higher floor.
We could see 3,900 to 5,500 in 2 weeks. I mean, that's essentially where we're at right now because of the lack of trading as it gets to sort of these nosebleed areas in terms of valuations. It just raises a question. Does it act as the same diversifier, the same stabilizer if it has this volatility? And that ultimately is going to be a question for a lot of hedge funds that are turning to this rather than, say, the U.S. dollar or treasuries.
Lots of earnings in the week ahead. We'll get Alphabet on Wednesday, Amazon on Thursday, and hopefully we'll get this on Friday, a payrolls report. We've tried to avoid this topic over the last week or so. Can we avoid a government shutdown?
Speaker Johnson says we're going to avoid it. He says he's confident, let's say by Tuesday, that is tomorrow, as we said over the weekend, that this will be wrapped up. But the path is not going to be easy because he has to go through a procedural matter of having a rule and then basically making sure most of the Republicans show up or trying to get some Democrats to agree to this, even though Minority Leader Hakeem Jeffries told him over the weekend, do not rely on Democrats for this vote. So basically, maybe tomorrow, but maybe not. It's not stuck in stone that we're going to get this. So Friday is a bit iffy.
That's the story down in Washington, D.C. The story for big tech, AI funding needs, and a bit of pushback from NVIDIA's Jensen Huang. No pushback to this, though. Oracle kicking off an 8-part US dollar bond offering with a big goal and some big fundraising.
Yeah, $50 billion with more than half of it coming from debt financing. Interestingly, you are seeing Oracle shares significantly higher in pre-market, although this comes after some significant declines so far this year. It raises this issue with Oracle. How are they going to fund some of their big promises, particularly tied to OpenAI? This gives some clarity to that. Nonetheless, there still are some very big questions about whether Oracle is overcommitting, especially given the pullback from NVIDIA, and what price are they going to pay in debt markets? How willing will the debt markets be to finance this?
Oracle up in the pre-market. On the equity side of things, we're higher by about 6%. Coming up this hour, we'll catch up with Darryl Cronk of Wells Fargo, with stocks heading for a fourth consecutive day of losses. Jason Thomas of Carlyle, as AI bubble concerns are growing, and Andrew Hoddenhorst of Citi, looking ahead to the January payrolls report. We begin this hour with stocks sliding to kick off a new trading month. Darryl Cronk of Wells Fargo writing, volatility is picking up rather quickly, centered in currency volume, commodity volume and rates volume. Thus far, it has not spilled materially yet into equity volatility. It's a market to watch for vulnerabilities and extremes. Darryl joins us now for more. Darryl, welcome to the program. We've seen that volatility pick up almost across all these different asset classes, with the exception of a couple. They're the big ones, bonds and equity. What gives?
Yeah, good morning, John. I think that's right. It's interesting because as the currency volatility and the commodity volatility really have been the epicenter of this, you haven't seen it as much in rates and certainly in equities. The VIX this morning at 18. Remember in November and October of last year, the VIX was at 28 intraday in both cases. So far, equities have not spilled through. A lot of this was the push out of some leveraged and weak hands in the silver and the gold markets on the speculation. It really hasn't changed the outlook for the strong economy, U.S. GDP growth. It hasn't changed the outlook for earnings for companies up to this point. So it's more episodic and idiosyncratic about where it's happening. But you do have to be careful about to the point about not being overly exposed in places where there are extremes or vulnerabilities.
Well, where do you think we should be focused on right now? We've had the blow up in JGBs, if we can call it that, the convulsions we've seen in both Bitcoin, crypto more broadly, and elsewhere in things like precious metals. What's next, and what would you be wary of?
Yeah, I think you have to watch and maybe lean away from, in the short term, some of the liquidity proxies. So Bitcoin's a great example, down 12% in the past week, basically, and year over year, if you look at it from where it was last year this time, down 22%, right? So it's really struggled, and it's predominantly a liquidity proxy. Certainly some of the commodities have been these liquidity proxies as well. So I think you stay away from those and you stay to more the tried and true. We still like large cap US, mid cap US. We would fade the small caps, even though they outperformed large by almost 500 basis points in the month of January. We're concerned about the durability. And again, if you want to stay away from kind of the edges of the market where liquidity extremes are the most prominent or lack thereof, you've got to kind of fade smalls, we think, at this point.
Daryl, would you go back into bonds as a liquidity proxy that seems to work amid this volatility?
It's a great question, Lisa. I mean, it's what everybody's trying to figure out, right? You know, is the U.S. Treasury the safe haven? Can you rely on it again? So we're very selective. We're what we call a bullet strategy right now on fixed income. Right in the intermediate section of the curve. We think the steepness is the best there, the roll down effect of what investors are getting. We still think on the long side of the curve, there's risk there. We would not go out and reach for yields in today's environment. Certainly if U.S. GDP growth picks up into 26, like we think we do, you've still got to price a little more growth premium into the long side of the curve. Oil prices having moved higher, admittedly down today, but having moved higher, also are going to put a little bit of a tailwind in inflation, right? We saw the PPI numbers last week. So if you start building in growth and inflation premiums on the long side of the curve, we think there's still some risk there that investors should kind of fade on the long side of the curve.
This is the difficulty about this moment. You have sort of these three prongs. On one hand, you've got the economy. On the other hand, you've got geopolitics. We haven't even touched Iran. And then, of course, you have the AI trade and this question of how far that can really power things at a time where valuations have gotten pretty elevated. How much are you worried that that particular leg is being called into question as we see the likes of Jensen Huang talk about the lack of a commitment to the $100 billion for OpenAI, and as you see other signs that maybe people are pushing back?
Yeah, it's a really great question, Lisa. I mean, what most people don't realize is they think when they stare at their portfolio or their screens, that tech is still the engine that's powering things forward. Tech and financials are two of the three sectors that are actually down year to date. It's been this heavy rotation into energy, materials, industrials. In fact, if I broke tech down, the dispersion between the haves and the have-nots are almost unbelievable in the first month of the year. Semiconductors up 15% for the month. Software inside of tech down 13%. So you've got almost a 30% dispersion just between semis and software. So you're going to have to go in and really be selective, even within the GIC sector itself or the technology sector, where you want to have that exposure as we move out into 2026 on the calendar.
Well, to Lisa's point, though, when you hear Jensen Huang talking about things with OpenAI, it was never a real commitment. And behind the scenes, he's talking about some issues he has with what the company is doing. Do you want to not have that direct exposure to the massive hyperscalers?
Yeah, it's a good question, Annmarie. I still think, to me, the funding element of this is somewhat overplayed. I don't think it's this circular or difficulty getting the funding that these hyperscalers or others need. I actually think the real choke point that ends up as we play this thing out through 2026 becoming the issue is, can I get the energy? Can I get the industrial companies that can supply on time and on budget with what the build is going to suggest for all the capex that we're counting on and delivering out into 2026? So frankly, I'm a little less worried about some of the funding noise and concerns about, will they get that versus more about how do we get to kind of phase two of this, right? We've solved the algorithms. We know we've made the commitments. We'll get the funding. Now the question is, can I get the energy? Can I get the industrial companies to help build the facility, the data centers and other things on time and on budget and as expected to meet the capex high bar of elevation that's sitting out there for 2026.
Jonathan's brought this up a lot of times, too, when it comes to the calendar for the rest of the year. The OpenAI IPO, though, how important is that for this trade?
I think I wouldn't say it's important for the trade overall. I think it's one milestone or one element on the confidence factor, right? Will investors show up and still pay some of those lofty valuations on expectations to come, right? Because the valuations are going to be tough to stomach, quite frankly, when you start looking at what those things are going to end up being based off of current or next year type of earnings. So you're really betting on the true future of these are game changers and what's happening. So I don't think it derails the trade. Frankly, what I think my biggest concern when I look out on the calendar, Annmarie, into 2026 is if we start to see capex expectations and budgets roll over, right? You don't have to have them stop on a cathartic heartbeat stop. You just need them to either show signs of peaking across the broad sector and starting to decelerate. And I think that's what will be more concerning for investors out into 2026.
Hey, Daryl, it's good to see you. Thank you, sir. Daryl Cronk there of Wells Fargo with the latest on this market. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. NVIDIA CEO Jensen Huang saying the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. The Wall Street Journal had earlier reported the investment plan announced in September had stalled after some people inside NVIDIA expressed doubts about the deal. Huang downplaying the report, saying NVIDIA will continue to invest in the ChatGPT maker. In sports, Carlos Alcaraz is the youngest tennis player in history to complete a career Grand Slam. Alcaraz beating Novak Djokovic in the Australian Open finals. After dropping the first set, the 22-year-old won the next 3 frames to win the tournament. Alcaraz saying he may get a kangaroo tattoo to commemorate his victory. Melania, a documentary about the First Lady, had a stronger than expected opening weekend at the box office despite poor reviews. According to ComScore, the film by Amazon and MGM Studios took in $7 million at US and Canadian theatres. The movie focuses on Melania Trump during the 20 days before President Trump's return to the White House last year. And that is your Bloomberg Brief. John.
Vonnie, thank you. Novak Djokovic is such a ridiculous athlete. Just think about how many Grand Slams there are every year. There's 4. And he's been in the finals 38 times.
I like that you just skipped over the Melania.
Oh, no,
you went straight to Djokovic.
No,
You're like saying they're
incredible
specimens.
Insane.
I think that truly amazing creatures that just defy humanity.
And to think Alcaraz could keep up with all of this over the next 20 years or however long he plays the game, it's just phenomenal what these guys do.
Yeah, I mean, the training that goes into that, I feel tired already.
And Rafa looks ancient now he's retired. They sort of aged 20 years after these guys stepped in.
Well, I understand why.
Yeah, okay. Of course I'm skipping over the movie and doing the sport.
You're so predictable.
Why would I talk about the movie that none of us have watched?
Well, true. I know people who watched it.
Oh, really?
Yes.
They got a review. What did they say?
They said, no, I'm not going to give this.
They went to the movies?
They did. I know some people who went to the movies.
Ticket.
Yeah, they did it for more comedy than anything else.
Oh, right, okay.
Let's move on.
Happy to. I tried to. Up next, the Morning Calls Plus, Jason Thomas of Carlisle, as AI bubble concerns are growing. That conversation up next.
There's a whole lot of stuff hitting the market all at once. And we said coming into this reporting season that it was a chance for investors to kind of push the macro aside and focus on the micro. The macro has been pretty pesky in terms of sticking around in unusual ways. And I would also argue that the micro has been a little bit underwhelming. We've described this as slightly squishy, not a disaster, but not good.
That was Laurie Calvasina of RBC Capital Markets joining the programme a little bit earlier on this morning. If you're just joining us, good morning. Equity futures on the S&P negative by 0.5% on the Nasdaq. We're down by 0.75%. That's the price action. Here's your morning calls. First up, Morgan Stanley downgrading Humana to underweight and slashing its price target. The firm citing vulnerability in the Medicare Advantage business. Elsewhere, Citizens JMP raising its price target on Amazon. The analyst expecting the tech giant to benefit from its partnership with Anthropic. And finally, Jefferies reiterating a buy on Oracle, saying the company is committed to its aggressive AI expansion. Sticking with Oracle, sources telling us here at Bloomberg the cloud company is tapping the debt market once again. Oracle looking to raise cash in an 8-part bond deal. Jason Thomas of Carlisle tracking the whole ecosystem for us, and he joins us now. Jason, welcome to the programme. I was reading a note of yours at the turn of the year. Absolutely fantastic read, actually available on the Carlisle website, so I suggest everyone should read it in full. Well, you talk about the ability to be bullish on the technology, but still sceptical on the valuations. Can you just run us through all of that?
Sure. I think if you look historically, what you see is that the market
in general, the equity market, has proven quite able at identifying truly transformative technologies. So if we look today and look at the cyclically adjusted price to earnings ratio, the prior times that it reached comparable levels was 1929 and 2000. That sounds kind of scary, given we all know what happened thereafter. But in both cases, you had a technology, it was electrification in the 1920s. You went from roughly 30% of homes to 70% of homes electrified in about an 8-year period. One could imagine just how exciting that technology would be in a world where homes were illuminated through kerosene lamps, where most of the mechanical power for manufacturing still came from steam. Similarly, of course, it was the internet that led to the big run-up in valuations in 2000, the potential for really just, again, the transformative change. And so in both cases, it wasn't that the technology fizzled. I mean, certainly electricity didn't prove to be some sort of fad. It was that the market wasn't so good at thinking second, third order effects. The capital really rushed in to the hardware bottlenecks. And of course, it was a huge run-up in both the capex, in terms of what the investment that was being deployed, but also, of course, the valuations. And almost all of the economics ultimately was more derivative and diffuse. It was the users of the technology where really the value accumulated, as opposed, again, to those hardware bottlenecks.
Jason, if you fast forward to today in 2026, we're seeing Oracle selling $20 to $25 billion this morning of bonds to finance some of their data center build-outs and their cloud computing. When you see all of the debt issuance tied to some of the hardware aspects of the bottlenecks that we're talking about, does that give you pause? Yeah. Does that raise concerns in your mind?
Oh, absolutely it does. Again, this is essentially what we saw in both of those prior episodes. This is where the capital is channeled. Today, the bottleneck, everyone agrees, is compute. And of course, the electricity to power that computational capacity. So that's where all of the money is moving in. But if the past is prologue, it's actually going to be the downstream users where most of the gains are. So for example, in electricity, the big run-up in valuations were the electric holding companies. And it was, of course, the electric equipment manufacturers. But when you looked 10 years later, it was the durable goods manufacturers. All of a sudden, you had products like electric blankets, stoves, refrigerators that didn't previously exist. So it was the electricity that allowed them to drive down the production costs, dramatic increase in productivity, but also created a market for the service. In addition, electrification spawned an entirely new industry because of the radio. Initially, radios were just viewed as durable goods like any others. The economics accrued to the manufacturers of radios. But by the end of the decade, of course, you had an entirely new industry, sponsored content. And in the Great Depression, even as radio sales fell, everything else in the economy fell, advertising on the radio rose sevenfold. Again, the internet birthed industries like social media, search. So even as the initial capital went into companies like Cisco, of course, the constraint then was bandwidth. It was the need for a new network architecture. So I think the message is that people should not be so concerned about the absolute increase in overall market capitalization. The concern should be the concentration, where it's been allocated. And I do think that some of the rotation that we've observed this year is just a sense among many investors that they cannot allow all of their incremental risk budget to be consumed by data centers, by this choke point, and having a much broader view of where the value of AI is ultimately going to accrue.
So, Jason, to put you on the spot a bit, do you think that some of the recent volatility and sell-off in some data center names or some big tech names is the beginning of a trend? Has some room to go in terms of the deflation of some of these valuations as the dispersion continues and as people try to shift away from some of this concentration risk?
Yes, I do. And the reason I say that, at the end of last year, having conversations with very large capital allocators, they're looking at their portfolio in real estate, in infrastructure, in credit increasingly, and of course, the big cap equities. And again, they see that all of their incremental risk budget for really the last 2 years has been consumed by this single thematic. And not just AI, we're talking about computational capacity for AI. So I think that this makes many people uneasy, and they're looking for ways to diversify. And I think it's an important point because you don't actually need to be bearish. You don't need to think that the expected returns on some of this development won't materialize. All you have to do is just be conscious of your prudential concentration limits to want to back off a bit.
Jason, you've written about this extensively. Just as a final point, this shift from asset light to asset heavy, do you think there's been a decent enough appreciation for what that means for valuations for some of these firms?
No, not at all. I mean, this is really, I think, the key. When you look at the decade prior to the onset of the pandemic, the companies were very richly valued, but deservedly so. They could grow revenue without any incremental hiring, any incremental investment. Everything was just falling to the bottom line to free cash flow. And so you had free cash flow yields, in many cases, that were in excess of 100% when measured relative to book value. So, of course, the valuation should be extremely high in those circumstances. These are like money printing machines. Today, of course, you've seen the decline in free cash flow relative to net income. And I think that as you move into a model that is somewhat different, where you are going to have to accumulate more physical on-balance sheet capital, you have to have a fundamental rethink of the appropriate valuation. And I just don't think that has happened to date. And the big question is also a lot of the idea was that this capex was going to be front-loaded. I'm not so sure that markets think that way anymore. It looks like there's going to, a question of depreciation rates, functional obsolescence, just the product replacement cycles. There could be a lot of maintenance capital spending going forward. And if so, I think that calls for a more fundamental re-rating of many of these formerly asset-light businesses.
Jason, thought-provoking stuff. Thank you, sir. Jason Thomas there of Carlyle. The Nasdaq down by about 0.75%. Experienced some of the things that Jason's talking about when we were over at the World Economic Forum in Davos, that when you ask people about valuations, they just keep defaulting to the technology. The technology is going to be really powerful. It's going to do this, and that. And it's really difficult to get them to come back to focus on the valuation story and the kind of details that Jason's going through.
Yeah, and the point that he was just making at the end there with you, this idea that they had been asset light and that the chips that they're buying might have a 3-year cycle. They're going to have to invest more in this. And we saw that with Microsoft. They can't spend enough to keep up with the demand, but they need to keep spending more. So it raises this question about, can you have a transformational technology that's at a valuation that's way too high for what the market currently is considering?
Stocks a little bit softer this morning. We're down 0.4% on the S&P. Coming up next, we'll catch up with Andrew Honhorst of Citi. Looking ahead to Friday's payrolls report, plus Yahira has your morning movers. Oracle rising as clarity comes to its data center funding needs. That stock is up by 5%. The opening about 60 minutes away. Futures down across the board, recovering slightly. We're down 0.5% on the S&P. On the Nasdaq, we're down by 0.75%. The Russell small caps down by 0.4. With your morning movers, let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Oracle shares have been swinging wildly this morning. All of it stemming from its plans to raise up to $50 billion to fund its AI cloud expansion. At first, that news had sent shares in the red, but they turned positive after both Fitch and Moody's affirmed their credit rating on Oracle. The headlines have been fast and furious. First, we had our reporting that has kicked off an $8-part dollar bond sale, and Oracle moments ago putting out a statement that it plans to sell $20 billion in common stock from time to time. Shares are up 4.25%. Meanwhile, moving on to U.S. rare earth stocks, they are rising in the pre-market. USA Rare Earth up 6% as we report on a planned announcement by President Trump for a $12 billion strategic minerals stockpile. It's being dubbed Project Vault, and it would be the first of its kind stockpile for the U.S. private sector. Of course, all part of an effort to reduce reliance on China for these critical supplies. And we end on Disney. It had earnings. Shares are now down 1.5%, even though the company delivered Its Parks and Cruises division delivered record results in the first quarter. More people are going to the park and they're spending more money. That unit is run by Josh D'Amaro, who we report may become the next CEO as the board closes in on a decision. John?
Yahara, thanks for the update. Appreciate it. Let's turn back to the economy. A busy week on deck, headlined by the payrolls report due on Friday. Bloomberg's Mike McKee has more for us. Good morning, Mike.
Good morning, John. Well, this is the first week we can say this in a long time. All of the data are going to be up to date. We're not looking at the effects of the government shutdown that we had last fall. We're still going to have to wait and see what happens with the government shutdown this time. Today we get ISM manufacturing. We'll see whether or not there is any expansion. The forecast is for contraction still. Tuesday jolts, and it's the December number, not behind there. Wednesday, ADP, ISM services, and don't forget the Treasury refunding. Thursday, jobless claims, and as you mentioned, Friday's big day, January jobs, and we get Michigan sentiment. Right now, in terms of January jobs, and it's early, we will see some changes in these forecasts, but the consensus at the moment is for 65,000 jobs, which would be an improvement. The whisper number, though, Wall Street's a little more pessimistic at the moment, 52,000. No change in unemployment seen and a decline in average hourly earnings. The other thing to keep in mind, guys, is that this is the month in which we get those updated numbers for payrolls and for the overall population. And so we could see a real change in how many jobs were created last year. Chris Waller's already predicting zero, zip, nada, is the way he put it. And that could change the political narrative in Washington quite a bit.
Mike McKee, thank you, sir, with the latest down in Washington, D.C. and what we can expect on Friday. The payrolls report, the estimate's pretty wide. 130 is the high, -10 is the low. Thank you, Santander and Standard Chartered, for those two extremes.
Yeah, and I was reading Steve Englander's note from Standard Chartered about why he has -10, and he's talking about the birth-death model and how it's coming out, and they're going to do all of these revisions lower in terms of the population and how that plays out. What do we do with that number? Will we get that number? How will these look? I mean, honestly, how much weight can we put on a number that we may or may not get on Friday that may or may not disclose something real versus changes in models that are coming once a year?
Steve just published US data quality, more fool's gold than gold standard.
Correct.
So I think that speaks to how Steve feels about the data that comes on Friday and beyond. Andrew Honhorst of Citi says this: the employment data is unlikely to materially change the outlook for the labour market. We expect a solid 135 added in January and the unemployment rate remaining unchanged at 4.4%. Andrew, that puts you at the top end of the estimates for this coming Friday. Walk us through why you're looking for that, but also looking for 75 basis points of cuts through the year.
Yeah, top end of the estimates in terms of where that payrolls number is going to be. But it goes back to what Lisa was talking about, what you were all talking about, which is, what does this data really tell us about what's going on in the labor market? So we know we have these issues with the birth-death model. I would actually agree with Steve Englander that if we get a big update to that birth-death model, you could get a zero or negative number. And I think that's where the underlying pace of job growth is running, somewhere right around zero. And that's what we had Governor Waller talking about in his dissent from the Fed staying on hold last week. So it's a complex job market, it is a complicated situation and complicated data. But I would go back to that survey that the Conference Board puts out, and they just ask people, do you think jobs are plentiful or do you think jobs are hard to get? And month after month, people are telling us jobs are becoming harder and harder to get. So I think it is a loosening labor market, lots of statistical issues, residual seasonality used to be something people would look at me very funny when I said. Now people are all familiar with it. Every year we get stronger jobs data at this time of year. We're building that into our forecasts. That's why we have 135,000.
What do you think break-even is? What's the break-even rate?
I think the break-even rate, with the way that the data are adjusted now, it seems like we can run about 50,000 jobs per month, and 50,000 jobs per month as reported by payrolls is leading the unemployment rate to stay stable where it is. But there is a question about that 50,000. Should you be subtracting something like 60,000 from it because those payrolls numbers keep being overstated? We'll get more information about that today or on Friday when we get the new report. So that break even has slowed down. But again, I think the key thing here is, do we call the job market strong if we have essentially zero increase in labor supply and zero hiring? I don't think that's a strong labor market.
Can you have a strong economy, though, if you don't have a strong labor market? I mean, this has been sort of a feature of the entire market for a while. The labor market has been sluggish at best, and yet the economy has continued to grow pretty dramatically. So at what point does that become a hamper, potentially, to any kind of further acceleration?
Yeah, I think eventually it does. I mean, there's growth, and then there's whether it's broad-based growth or fairly focused growth. And to the extent that we're getting growth from things that are AI-related, software and data centers, a lot of those kinds of areas of investment spending don't actually generate a lot of new jobs. And so that eventually becomes an issue for the economy. In the short term, you run strong growth and you can have weaker labor market. And I think that's what we're seeing right now. But eventually, people don't have the wage income to purchase. And if you look at consumer spending, it's holding up, but it's holding up because the savings rate keeps going down. People are saving less and less because their incomes aren't tracking with that consumption. So eventually it's an issue for the economy.
You still think that the Fed is on track to cut by 75 basis points this year, even with Kevin Warsh potentially being the Fed chair? Why not more, given some of the proclamations that we've heard from certainly President Trump as well as Kevin Warsh, and considering the weakness that you see in the labor market?
I think the risks are that we do end up with more cuts than 75 basis points rather than less cuts than 75 basis points. The reason I think 75 makes sense as a base case is, although the labor market is softening and loosening, it's happening very gradually. So if we just project out that gradual loosening of the labor market, the unemployment rate will move up just a bit this year. Inflation will come down a bit this year. And that would mean that the Fed should just ease policy rates by a bit this year back to something closer to neutral, which 50, 75 basis points lower would be neutral. I think that should be the base case. The market has about 50. I have about 75. But what's the risk? The risk is that when you're in an environment where hiring is so weak, if there's any pickup in layoffs, that unemployment rate is going to shoot up, and then we'll get more cuts.
Well, you haven't changed your expectation, even though we have a new nomination for the Fed. So do you think a Kevin Warsh is going to be data dependent, given what you're basing this off as the data that you expect to come out?
Yeah, it's not just Kevin Warsh, and I think that's an important point, that it's the committee as a whole. That committee has been data dependent. I do expect Kevin Warsh as an individual to be data dependent as well. So depending on where that inflation data comes in the second half, and I think that's really important and probably underemphasized. A lot of focus on the labor market right now, and that's appropriate. But those inflation numbers, I think, by the second half are going to look closer to 2% inflation. And that's not just going to give Kevin Warsh the ability to cut interest rates. I think that will give a lot of members of the committee the confidence that they can bring rates lower.
What's the source of that? What's driving us back to 2?
Shelter cooling is where we have the most confidence. I think a lot of economists have that in their forecast now. We just have so many indicators. It's a soft housing sector. The housing sector is soft right now. Prices are soft. Rents are soft. But this loosening labor market should also give us confidence that inflation will come down further. And then finally, that tariff boost that we think is about 50 basis points in CPI and PCE right now, that should be dissipating by the
So let's just go with the shelter story, because when people like you explain the shelter story, it sounds so intuitive. It sounds like common sense. OK, you've put it that way. I can see where it's going to be several months out in the official data. Why do Federal Reserve officials not share the confidence you have about the disinflationary tailwinds that are already coming down the pipeline?
I think there's a difference between different Fed officials, and different officials will be different places on this. Where I am, and maybe some of the more dovish officials are saying, yeah, we basically can forecast this thing 6 months to a year in advance. We know that it's going to cool down. I think there are other Fed officials that maybe also kind of know that we can forecast that, but think that the way they should behave is if we can, because they think it's important to take a strong stand against inflation. You see 3% right now, and they think we're supposed to react to that 3%, not the forecast of where we're going. I react to the forecast. I think other Fed officials do, but I think that's a difference of opinion in terms of how you conduct monetary policy.
So in other words, this is about appearances. This is about appearing hard on inflation, even if they'll come down on the same side as the doves. In other words, do you agree with Kevin Warsh that people should just talk less and not really give forward guidance?
I do think forward guidance is, we're probably overly used to forward guidance because we were in these strange scenarios where you had to give guidance about keeping policy rates at the lower bound for a long period of time. So we should be moving away from that. In terms of this, is it kind of, optics talking about inflation? It's hard to make an argument that 3% inflation is a lot worse for the economy than 2% inflation. The target is 2%, so there is an optics reason that you want to be at 2%. if central banks were to do it over again, I think most economists would say probably we should have had a range of inflation that would have been acceptable. So I do think it's a lot about optics right now.
This is fascinating, especially because the person who is likely to come in to be the next Fed chair is an inflation hawk, at least traditionally, more than a decade ago. And people are saying people can change in that time. Do you think that he is also potentially going to accept 3% as a new 2% and be more dovish in the approach because it hasn't been a problem? And frankly, if people were to come back, that might be the more appropriate target.
Yeah, I'm not suggesting, and I don't think that Kevin Warsh is going to say that 3% should be the new 2%, that we should be changing the target right now when we've just overshot for multiple years. But I do think this idea that we can't be hypersensitive to his inflation off by, a tenth of a percentage point here or there. I think the more you kind of immerse yourself in this data and understand what the data are and all the issues in producing it and the different choices that we make, it's hard to get really excited about being off by a few basis points. So I'd like to see them move in that direction, and possibly they will.
To your point, though, Andrew, I think there's a realization on the committee that they can shape the events they influence. And they can basically sit here and say, you know what, we can shape the events we anticipate by saying things like I'm not worried about inflation could actually contribute to inflation. Yeah. Is that ultimately what you're getting at?
Yeah, I think that's exactly the concern. The reason I would be less concerned about that now is because we have all of these indications that we're not in an environment where we have a bunch of upside around inflation. And it is actually the opposite of where we were when Fed officials were saying they weren't that concerned about inflation when everything was supposed to be transitive. We had a tight labor market. We had wages that were accelerating, prices that were accelerating all over the place. All of those things are decelerating now. So I think you can be a lot more confident that we're going to get inflation lower.
Andrew, it's good to see you.
Thank
you, sir. Andrew Honhorst of Citi on the optics over at the Federal Reserve.
I think it's a little cute. I think that he's not wrong, but I do think that there is this feeling that if you act like you're hard on inflation, you can drive down inflation in a de facto way. I don't think any company looks out and says, I'm going to raise prices because they seem less concerned about inflation. I mean, if you think about how it plays out in markets, I'm not sure it's that direct, but it is kind of this funny, potentially influencing the world that they cover.
And that's the game, apparently. Equity futures right now in the S&P, negative by about 0.4%, with an update on stories worldwide. Here's your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. A partial U.S. government shutdown entering its third day. House Speaker Mike Johnson is hoping for a vote on funding bills today. Minority Leader Hakeem Jeffries saying Democrats want an agreement on their demands for reforms at DHS before they'll vote in favour of the package to reopen the government. Disney earnings beating Wall Street estimates on both the top and bottom lines. The bulk of the company's profits coming from its parks and cruises unit, led by Josh D'Amaro. And sources telling us here at Bloomberg that D'Amaro is a likely successor to CEO Bob Iger. The board is expected to vote on a new CEO in the coming week. Bad Bunny making history at the Grammys, marking the first time the album of the year has gone to a Spanish-language work. The Puerto Rican superstar dedicated his acceptance speech to, quote, all the people who had to leave their homeland. Country star Shabuzi, who won his first Grammy, dedicated his award to immigrants. And that is your Bloomberg brief. John.
Bonnie, thank you. Thank you very much. Up next, we're setting you up for the day ahead. Plus, we'll catch up with Oksana Aronoff of JP Morgan Asset Management, weighing in on the next Fed Chair.
Of the options, it's a pretty strong pick for the president. I know there's some people who question, what these hearings are going to be like when he gets there because of positions he took against quantitative easing after the financial crisis. If the Senate can confirm Tulsi Gabbard to DNI and Kristi Noem to DHS, I don't think it's going to be much of a challenge for them to confirm Kevin Warsh here to the Fed.
That was Mark Shaw. Good fun a little bit earlier on Kevin Warsh and the future of the Federal Reserve. If you're just joining us, a volatile start to the trading week. Things are calming down just a bit going into the opening bell. Equity futures negative by 0.4 on the S&P, and the Nasdaq 100 down by 0.7. That's the price action. Your week ahead looks like this. Today, ISM manufacturing data, plus we'll get a little bit of Fed speak. On Tuesday, jobs data and results from AMD, Pfizer and Pepsi. Wednesday, results from Alphabet. Thursday, some central bank decisions and results from Amazon. Plus, another round of jobless claims. Then Friday, hopefully the big one, hopefully we get some payrolls data this Friday.
Oh, I don't even want to hear this. I mean, honestly, why are we in a shutdown again? Hopefully it'll be over by tomorrow. That's what they say.
And then we wake up, we don't talk about it, and we just move on with life.
Let's do that.
No one really wants to talk about these things,
well,
do they?
Because there's nothing to say. It's Groundhog's Day, literally. And here we are again with the government shutdown.
Should we talk about Kevin Walsh? And who is Kevin Walsh?
Please. Yeah.
Another round of that. Literally Groundhog Day.
Literally
who is Kevin
every single
Walsh?
topic. Okay.
Oksana Aronoff of JP Morgan Asset Management with this to say, even in the most dovish scenario, this cutting cycle is closer to the end than the beginning. Oksana joins us now for more. Oksana, good morning.
Good morning.
Does Kevin Walsh move the dial for you and the team at all?
Well, I'm afraid to talk about it now. No. I mean, look, it's important to say that it will be interesting to see how he's going to reconcile his historically, hawkish stand on the Fed balance sheet, on inflation, and Trump's desire to see lower rates. And how he's going to achieve this balancing act, we'll see whether he's going to have to compromise on some of those views. But even if you assumed he was going to be the most dovish of doves, as you said there, we are closer to the end than the beginning. And frankly, this cutting cycle achieved very little, if anything at all, in terms of affordability, in terms of really getting long rates significantly lower. And now, of course, all eyes are on whether inflation risks are to the upside. Over 50% of CPI is running at or growing at least 3%. Shelter being a significant dampener, but, and I don't know that a lot of people talk about this, if we were to actually see mortgage rates go lower, what is that going to do to home prices in an ecosystem where there's very, very limited supply? It's going to send prices higher. So it might actually be, have a counterproductive effect in that respect.
I guess there's a bigger question right now, markets too, which is how much does it matter what the Federal Reserve does with interest rates? How interest rate sensitive is both this equity and this credit market? When it comes to credit markets in particular, where some people say it's priced to perfection, how important is it for the Fed to cut rates more aggressively going forward?
It doesn't matter whatsoever as long as the government balance sheet is in the shape that it is in. We're staring down the barrel of tens of billions of dollars more stimulus this year. And of course, and I've been saying this for a long time, the long end of the curve doesn't care what the Fed is doing at the front end of the curve. The long end of the curve is reacting to the fiscal policy. It's reacting to inflation expectations, which have moved up for the next year in terms of what consumers are expecting. It's reacting to supply of treasuries. And so it's very, this cycle is very different for that reason. It hasn't really reacted to Fed policy decision making at the front end of the curve.
Does it give you confidence that we haven't seen more volatility, particularly at the long end of the curve, even with all of the volatility that we see in precious metals and gold and silver, et cetera? I mean, this has actually been one of the havens, frankly, in terms of just price movement.
So it's interesting to me generally for credit that we haven't seen more volatility, or for equities, although equities kind of move in their own ecosystem. We arguably have one of the most volatile administrations. And we are not really seeing that in markets. And I think part of that is the Fed put, right? This sort of implicit expectation that the Fed put is always there for you. It's always going to be there, come to your rescue. And that's where, Walsh's candidacy is interesting. If he doesn't really believe in continuous expansion of the balance sheet, which is already quite large at $6.5 trillion, then is the Fed put really there? I mean, he's been very vocal about saying that, look, the Fed should have a smaller footprint on the economy, on markets. So I really am wondering, as we are seeing these record tights in credit, whether that's really sustainable, particularly in, of course, the private credit ecosystem. And there's nothing inherently wrong about it. It's just the way that it has evolved, where in prior cycles it was predominantly focused in the bank lending space. Now it's, of course, non-banking funds lending. And so it's just become a much more opaque ecosystem and a significantly larger one.
When you look at Kevin Walsh and the president's obvious lens of affordability this year, does he make sense and match up?
So this is what the balancing act is going to have to be all about. How do you achieve affordability by simply cutting rates? It hasn't worked so far. And then also, if you believe that the Fed's balance sheet should be smaller and you are concerned about inflation, which inflation risks, when I look out, I really, contrary to your prior speaker here, I think the risks to inflation are skewed to the upside because I struggle to see what is actually bringing it down, whether you look at demographics, whether you look at immigration policy, whether you look at really anything that is supporting or has effect on the inflation number, including the actual, specific things like PPI that came out recently, more than double what was expected, right? Inflation risks are actually skewed to the upside. And if he's going to respect that, then you have to at least stand pat on rates. But even if you were to cut them, we've seen that hasn't been effective.
Andrew was talking about shelter. Where do you see fresh catalysts for inflation?
In shelter. So in terms of lower borrowing costs there, that can create actually a higher pricing impetus for shelter. Generally, there are more households. There's, household formation has outstripped supply for many decades now in this country. And that is what's driven prices higher, significantly higher. And that's going to keep prices relatively high. Now, shelter has experienced some softness because mortgage rates are so high, because it has become less affordable, but it's not going to be a reliable sort of, dampener, a consistent dampener to inflation over the long term.
Let's say Chair Walsh is a hawk. Just want to throw this out there. Doesn't that make it more likely long rates fall than rise?
Paradoxically, yes. And I've said this for a long time, that for the Fed to achieve their, supposedly still 2% target, which, by the way, I'm not saying that it's the right target and that there's anything wrong with a 3% target, but it is very meaningful that they haven't changed it so far, right? Paradoxically, for them to achieve it, they need to sound more hawkish than dovish. It's sort of counterproductive what they're doing.
Oksana, good to see you. Oksana Aronoff there of JP Morgan Asset Management, which kind of speaks to one of the things that Andrew said about 5 or 10 minutes ago.
Yeah, that essentially they have to kind of almost tacitly accept a 2 to 3% inflation rate in order to have some of the rate cuts that they're hoping for. Interestingly, though, if he is hawkish even on letting the balance sheet roll off of the Federal Reserve, that would lead to more tightness. That would then lead them to be able to cut rates, but would also bring long-term rates down, but maybe not for the reasons people want.
Bonds are a snooze this morning. Yields are up by about a basis point on 10s. Equities are recovering. We're down by about 1/3%. Coming up tomorrow, we'll catch up with Chris Ferrone of Strategas, Victoria Fernandez of Crossmark, Dan Greenhouse of Solus, and Chris Harvey of CIBC from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.